The start of cash equities trading, here are your headlines. Big bank earnings kick off. JP Morgan and Goldman Sachs report today. The ECB warns excessive dividends for European lenders may be off the table. Britain's biggest banks will be freed from the Bank of England's pandemic dividend restrictions. We hear from the Governor of the Bank of England, Andrew Bailey, at 8:30 London time. Plus, UK scientists warn the country could see as many as 200 deaths a day at the next virus peak. In France, President Emmanuel Macron says vaccination will be compulsory for healthcare workers. Let's take a look at your futures then this morning. So 15 seconds to go until the start of Tuesday's trading day, and things improving just a little bit. We have a flat picture really on futures, but not as negative as maybe they were just half an hour ago. We have a flat to negative picture for US futures, down around 0.1% on E-mini and Dow futures, fairly flat for Nasdaq futures. So as European equity markets just get into their stride, we will have a look at where we managed to open up on these European equity markets. So the FTSE 100 is up by 0.1% this morning. That is the first of these markets to open up. The IBEX over in Spain also up by 0.1%. We are going to be focused from a macro perspective, as we were discussing with Mark earlier. We're going to be focused on the inflation data due out from the United States, forecast to be the highest since 1991. Are we going to be seeing an overheating US economy into the summer and beyond? That was the concern of our guest in the last hour, Sebastian Riedler. So we'll keep an eye on that story, and we'll build our way towards that inflation data here in Europe, of course. The other focus for the markets right now is around the banking sector and the ability of banks globally to pay out, whether that is in the United States or in Europe or here in the UK. And we've had plenty of news lines around all of that in just the last 24 hours or so. So let's get to some of it. The Bank of England is removing restrictions on bank dividend payouts. It says these extraordinary measures brought in during the pandemic are no longer necessary. The rollout of vaccinations and results of interim stress tests bolstered the central bank's view that lenders could return to a standard approach to capital setting and shareholder distribution. Joining us now is Simon French, Panmure Gordon, Chief Economist. Simon, interesting, well, very good morning to you first.
Done so well for us.
Let's deal with this with some pleasantries. Simon, good morning. Let me get into the banking conversation, though, with you. It's interesting to see what seems to be a bit of a divide across the channel here. The UK, the Bank of England suggesting that banks can go back to deciding what to pay out. The ECB suggesting there might be some limits, even though they're removing the caps later this year. They might still want banks to pay out an average dividend, nothing too record setting. What are you expecting around payouts from the banking sector?
So I think when you speak to Andrew Bailey later this morning, he can be forgiven for feeling a little bit smug. It has to be said that the last 16 months, financial stability, a tightening of financial conditions has been the dog that has not barked in this crisis. We saw the aggressive spike in corporate sovereign yields in March 2020, but they came down within 30 days, and that contrasts very sharply with both the 2008-9 experience and again 2011-12 during the Euro crisis. So in terms of how that translates through to bank dividends, I don't think there's any surprise really this morning that against that backdrop, the banks are going to be allowed in the UK to release more capital. I think you talk to a more cautious approach to within Europe, which actually is consistent with the pace of recovery. I think the Eurozone is expected to grow around 4% this year, with actually risk growing on the downside because of the growing Delta variant, where in the UK consensus is almost 7%. And actually we heard last night, of course, the reopening moves now to stage 4. So a divergent recovery and a divergent path for bank payouts.
Okay, so that makes sense. And we are seeing that some of the UK-listed banks are moving higher this morning as a result of those news lines coming through from the Bank of England in the Financial Stability Report. The other thing coming through in terms of the UK story, Simon, right now, and sits more comfortably perhaps within your role as chief economist, the other thing that's coming through is there's not too much concern around what has been called, well, and has been, the UK's tax cut-fueled housing boom. Not too much concern around that at the Bank of England. We've talked before about the increased sort of utility value that people in many parts of the world attach to housing during a pandemic. When you have to work there and live there and spend so much time there, you might be prepared to pay more for it. How concerned are you about the boom in the housing sector that we've seen, certainly up until very recently?
Yeah, well, thank you, first of all, for sort of citing what I think is the key determinant. Yes, there are fiscal changes, the reduction in stamp duty in the UK that has added fuel, but the fire started burning with that utility shift. And it's one of the reasons why the Bank of England has sounded relatively relaxed. But the other major reason is, of course, while UK house prices is at an all-time nominal high, when you start adjusting for prices, it takes you back to 2008 levels. And actually, when you start to adjust for household incomes, actually, they're still £40,000 in today's prices lower, that's the average price, than they were in 2008. So I think reasons for a degree of, I wouldn't say relaxation, but certainly a sanguine assessment from the Financial Policy Committee. Overall, though, there is a bigger agenda perhaps than financial stability at play, which is, of course, the recent pickup in house prices is going to start to cause some societal problems, particularly in parts of the UK, and I think this is probably the final word I'd say, parts of the UK that are not used to runaway house price growth have started to see it and generating the sort of unease that we've perhaps seen in London and the South East, spreading around the rest of the United Kingdom.
Yes, and let me ask you about something else the Bank of England flags, and that's UK corporate debt levels. And in fact, they sound fairly relaxed here. They remain vigilant to debt vulnerabilities, and they're talking about, they're giving us some further thoughts on that subject this morning. This all coming from the Financial Stability Report. But this goes back to something I remember talking about with you, Simon, a year and a half ago when we were in the heart of this. Lots of UK companies, just as companies in other parts of the world, loading up on debt to shore up balance sheets, to see them through tough times through the pandemic. And that seemed like the right thing to do for many businesses, but then maybe it leaves you with a debt problem afterwards, depending on what line of business you are in. Is that something that concerns you?
It does concern me. I think you're right to cast our memory back to when corporate UK started to build up. There was about, in the SME sector, about £50 billion of additional funds taken out over that period, the first couple of quarters following the pandemic. And actually that reversed a lot of the deleveraging that has taken place over the last decade. I think why, again, it does read quite relaxed regarding the overhang is because the Treasury have pointed to the fact that the liabilities are going to be managed in terms of the overhang that will have on balance sheets and on cash flows by this pay-as-you-grow initiative announced earlier in the year. And this is the idea that actually the repayments of those debts and therefore the servicing costs spread out depending on the recovery of the underlying corporates. And that is one of the forbearance measures, one of the liability smoothing measures that the fiscal authority can help monetary and financial stability authorities work in lockstep. That's the kind of joined-up policy making that isn't always apparent, but is in this case.
Okay, Simon, thanks very much. Something to celebrate. Simon French, Pam Gordon, Chief Economist, who stays with us here on this programme. Lots more to discuss with Simon. And lots more to come on the Bank of England's Financial Stability Report as well. We'll continue our coverage of that. Governor Andrew Bailey of the Bank of England will be speaking at 8:30 UK time. So in around 23 minutes' time, we'll bring you his statement and some of that press conference as well. Coming up here on this programme then, government's race to ramp up vaccinations as the Delta variant continues to spread. We'll take a look at what that means for global reopening efforts. More on that next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the European Market Open. European equity markets then reflecting kind of the opposite of yesterday. Yesterday we saw everything but the FTSE rally. Today we see everything but the FTSE in negative territory, it seems. The FTSE 100 going its own way, up by 0.3%. We're just getting some news lines coming through from the PBOC, the central bank in China. A spokesperson there announcing the financial statistics of the first half of 2021. So you see here live pictures from Beijing, the spokeswoman at the PBOC saying that macro leverage ratios have been brought down and are expected to be stable. The RRR cut, this is the reserve requirement ratio cut we saw for the banking sector in China. That RRR cut, she says, will help to lower aggregate financing costs. So seen as something that's beneficial to the banking sector, reducing the amount of cash they need to, or liquidity they need to keep on hand, essentially all those buffers they need to keep on hand. So those lines coming through. Financial risks in key areas have been prevented and resolved in the first half. So interesting to see these lines from the PBOC as we track risks identified by global central banks. Let's take a look at what is on the move this morning. We've got some movers for you. The banking sector very much at the heart of things. But let me start with what's going on at Nokia, the telecom equipment company, increasing its guidance after a strong second quarter. That's the story there, and that stock up by just over 5%. We also have news coming through on the banking sector, and we've talked about this quite a lot already. We've seen that the UK banks have been pushed higher by being let off a leash, I suppose, by the Bank of England. Will there be any nuance added to that by the Governor, Andrew Bailey, later on today in around 20 minutes' time when we hear from him around the ability of banks to pay out dividends right now? How will that look in the immediate aftermath, or whilst we're still dealing with a pandemic, or will that be for the banks to decide? We see HSBC up by 1.5% right now. Bit of a contrast between what's happening at HSBC and over at the EC, or rather UK banks, versus the ECB and their news lines this morning. Let's get to Swatch. We're also hearing from Swatch returning to profits is the story coming through from that watchmaker, and the numbers coming through from Swatch today described as solid by analysts at Bernstein, citing stores reopening, travel resuming. That would be nice. The Swatch Group share price up by 1.6% this morning. Let's get a Bloomberg Business Flash. Top corporate stories we're focused on then. Here's Laura.
Thanks, Anna. The problems for the Boeing 787 Dreamliner continue. Bloomberg's learned the company has uncovered an additional manufacturing problem with the plane. It has to do with the forward pressure bulkhead in the 787's nose. It's not considered a threat to flight safety, but Boeing has halted deliveries of the plane since May. Regulators are looking at tiny imperfections that have cropped up on the lining of the jet's carbon fiber airframes. Disney has been investing heavily in new packages of sports rides, and viewers will pick up the tab. The company is raising the price of its ESPN Plus sports streaming service by 17%. It will go from $6 a month to $7 a month. ESPN Plus is the smallest of Disney's streaming services. It has 3.8 million subscribers. That's the Bloomberg Business Flash. Anna.
Thanks very much, Laura, with your Business Flash here in London. Let's turn to the latest on coronavirus. And countries are racing to vaccinate as the more contagious Delta variant spreads around the world. The French President Emmanuel Macron has ordered all healthcare workers to get vaccinated by September the 15th. In the UK, scientists are estimating England faces up to 200 deaths a day after restrictions end. British Prime Minister Boris Johnson has been urging people to remain vigilant against the virus.
This pandemic is not over. This disease, coronavirus, continues to carry risks for you and your family. We cannot simply revert instantly from Monday the 19th of July to life as it was before COVID. We will stick to our plan to lift legal restrictions and to lift social distancing.
Let's talk to Simon French, Panmure Gordon chief economist, and get an economist's perspective on what is, of course, a human story and a health tragedy, Simon, which we never forget. But let's think about where the global growth story goes from here. Is your focus of concern around those parts of the world where we are seeing low vaccination rates and how they will manage to deal with this much more transmissible Delta variant?
Absolutely. I think what you look at in terms of the global recovery is a set of very strong metrics at the aggregate. Global trade has recovered to more than 6% higher than its pre-pandemic levels, and that is far, far faster than we saw in the last comparable economic episode, the global financial crisis. Global PMIs are strong, global growth momentum at the aggregate is strong, but you're right to say that there are pockets of low vaccination prevalence where will actually limit and spill over on the amount of economic activity that even those countries with much better vaccine rollout performance can operate within, both on a commerce level but also on a tourism level. And it is that spillover effect that you worry about, not just in terms of the bottom line in terms of commerce, but you rightly say in the intro, this is also a health pandemic. And one of the big uncertainties regarding all the pathways from particularly the developed economies out of this is the degree which a further variant may emerge in one of the countries where the virus is still far more prevalent.
And we're also thinking about recovery and charting a course out of the pandemic, of course, Simon, in countries where we do have high vaccination rates and how we do that. I'm interested to see actually the Chinese example here, and many people have been looking at the latest measures from the central bank there, the PBOC cutting the RRR rate at the end of last week, just holding a press conference this morning saying that that cut will help to lower aggregate financing costs. And maybe some people were caught a little surprised by this, seeing this measure as necessary. Many people would have put China in a box of countries that had done well to deal with the pandemic, and then to see them need to bring in further support to the Chinese economy may surprise some people. Are you surprised by what China is having to do here to support its economy?
No, but I can understand the confusion, perhaps the question marks over why this has happened at this point. So let's try and unpack this. Well, you're absolutely right. As always, the China economy recovered fastest amongst the major economies from the pandemic. And you would think, therefore, that additional monetary stimulus at this point was unnecessary. But of course, they are trying now, and I think this is a sensible move, on some of the structural reforms, particularly in the environmental space, the energy transition space, some of the speculative activity, particularly in commodities trading, trying to reduce some of that activity out of the economy. And they're trying to lean against a potential slowdown that may have through monetary stimulus, through the cut in the reserve requirement ratio. And we were looking at previous RRR cuts, and normally that puts about 150 to 200 basis points worth of growth in M3 in broad money. And currently that's growing at about 8.2% in China. I think the Chinese authorities would be happier with that at 9.5, 10, consistent with their nominal GDP growth rate.
And do you see this as any kind of warning sign, Simon, for how long we might live with pandemic measures in other parts of the world? How long it might be necessary for monetary and fiscal support to be provided to Western economies? Does the China example teach us anything about that?
Well, it's another piece in the jigsaw, and the jigsaw is telling us, as it emerges as a picture, that monetary authorities and fiscal authorities are unlikely to be fighting themselves in the way that they did in many geographies after the global financial crisis. There is an emerging consensus that stimulus can afford to be very supportive, generate the kind of exit velocity. The question, and we talked about it at the top of the hour, about financial stability risks that may emerge from those very loose conditions. You talked also in your intro, the back end of actually last hour, the inflationary prints, most obviously in the United States, but elsewhere, that may be yielded as a result of this. But I do think the reserve requirement ratio cut in China tells us a broader picture of monetary authorities keeping their foot to the floor for a very, very long time, and prepared to see not just the whites of the eyes of inflation, but probably inside the retina as well.
Yeah, we'll certainly watch for that then. We'll see what the data reveals later on. Simon, thank you very much. Simon French, Pamela Gordon's chief economist. Thanks for joining us. And Simon will be continuing his conversation with us on Bloomberg Radio at 9 a.m. UK time. I will be heading there. Looking forward to speaking further with him on Bloomberg Radio later this morning. Coming up on this programme, US bank stocks are squeezed and the ECB urges caution on lenders. What does this mean for earnings season? We'll talk about what the US bank's messaging is going to be around earnings. That's coming up next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the European Market Open. 22 minutes into our trading session, which, as I mentioned before, looks a little bit different to yesterday in that the FTSE is going its own way, but in the other direction. So the FTSE 100 bouncing up by 0.2%. In contrast to yesterday, where it underperformed. Elsewhere today, we see European equity markets under a bit of pressure. And we see banks here in the UK, though, moving to the upside. And some of the individual earnings stories cutting through, as you see there on the Swatch Group share price. Now, US bank stocks are under pressure on speculation that second quarter results won't justify an ongoing bull run. Despite the sector soaring 28% in the first half of the year, JP Morgan and other lenders are warning that the revenue boom is slowing. At the same time, the European Central Bank is warning banks to remain cautious and could take steps to limit excessive dividends, whereas the Bank of England has removed restrictions on bank dividend payouts. A lot of contrasting ebbs and flows then for the banking sector. Let's think about all of these with Nabila Ahmed, Bloomberg's Asia finance reporter, who's been casting her eye globally over all of this news flow for us. Good morning to you, Nabila. So Wall Street Bank earnings then kicking off in just a few hours' time. What are expectations like?
Anna, good morning to you. Well, look, this time last year, we had bumper results across Wall Street, which helped fuel those bumper dividends and payouts that we saw. This year might be a little bit different. So we are expecting a big drop across trading revenues as volatility has come off. Remember, as markets have stabilized as the pandemic stabilizes, that has that has sort of hurt trading activity. And we're talking about something like a 28% drop in combined revenue across the big 5 banks. So the question is, can they make up for it elsewhere, Anna?
Yeah, absolutely. And one of the ways they might want to try, or might have been trying, is through deal making. I'm just looking at the MA Go function on the Bloomberg to see what kind of uptick we've seen year on year in M&A activity in North America, 87% more than the previous year. Of course, last year, the first half of it might have been a bit of a low point. But what can deal making do, that revenue, what can that do to make up for the shortfall in trading?
Well, that is the big question. Deal makers have definitely stepped into the limelight this year. They're having a gangbuster year. In the first half, we already had $2.5 trillion of deals announced. And, you know, you had bankers talking about kind of this Goldilocks moment. So you've got Goldman Sachs, which has been the traditionally #1 deal-making bank. They've raced ahead to $1 trillion in deals faster than they've ever done before. We're talking about a record year all around. And what we're trying to see is what revenues actually have come out of that. Remember that when you do a big transaction, that's aligning to that company to be able to do a stock buyback for them, for example, or equity raising or debt raising. And the banks are trying to maximize their fees from those activities as well as just the deal making side, to trying to make up for this gap in the trading revenue.
And just briefly, the latest lines on the ECB, we're seeing a mixed picture for Eurozone listed banks this morning.
Yeah, look, the Eurozone listed banks are being warned not to hand out excessive dividends. Remember that they're still under pressure. They can't actually start handing anything out until September because they were banned during the pandemic from paying anything out. Between the biggest banks, they've got about $26 billion in excess cash, and investors are now starting to really wonder when and whether they are actually going to see some of that.
Okay, thanks so much, Nabila. Really good to get your update on all of these themes. Nabila Ahmed, Bloomberg's Asia finance reporter. We see UK banking stocks moving to the upside, though, and that is because what we've heard from the Bank of England this morning on its stability report. It's hosting a press conference after publishing that stability report. We'll get live to that press conference shortly, right here on Bloomberg TV. This is Bloomberg.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tierney Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance and more.
2022年完成空间站的在轨建造，建成国家太空间之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station.
出发，是，敬礼。
China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. Half an hour into Tuesday's trading session, which overall is fairly flat, but we do see some divergence between London and the rest. The DAX and the CAC down by 0.1%, the FTSE 100 up by 0.3% or so. Let's have a look at where we are on a sector breakdown, and that'll really tell you what you need to know about the UK story right now. Certainly to the upside in terms of sectors, we see that the mining sector is doing pretty well. Telecoms also moving higher, chemicals, technology, retail. But we're divided really, aren't we, across Europe, with those sectors moving higher and those moving lower, and banks right in the middle of that mix, because we've got a couple of divergent themes going on here. On the one hand, we have the ECB talking about limiting the ability of banks to pay out, even when they remove those caps a little bit later on this year. They don't want record-breaking payouts from the banking sector, still dealing with the pandemic, as we are across Europe. So that is the ECB story, if you like, but the UK banking story looks a little bit different, and so that's why we see the banking sector as a whole kind of playing mid-table, I suppose you'd put it in football parlance. But this is what we've got for the banking sector this morning in the UK then. UK banks moving to the upside, and this comes as a response to the financial stability report we got out from the UK banking sector, where they are removing the restrictions on banks' ability to pay out dividends to shareholders. This lifted HSBC in the Hong Kong trading session, now lifts it in London and lifts other banks beyond. Let's get a Bloomberg First Word News update. For that, here's Laura.
Thanks, Anna. White House officials are discussing proposals for a digital trade agreement covering Indo-Pacific economies as the administration seeks ways to check China's influence in the region. That's according to a Bloomberg source. Details of the potential agreement are still being drafted, but the pact could potentially include countries such as Canada, Chile, Japan, Malaysia, Australia, New Zealand, and Singapore. French President Emmanuel Macron turned up the pressure to get vaccinated. He said getting the COVID shot will be mandatory for healthcare workers, and so-called health passes, which show proof of negative tests or vaccination, will be obligatory in venues like restaurants and cafes. The European Central Bank could take steps to ensure that lenders avoid paying excessive dividends later this year. That's when it will likely lift a cap on payouts. A member of the ECB's supervisory board, Margarita Delgado, says the central bank will call on lenders to remain cautious. Those remarks dampen the possibility that there will be a surge in bank payouts. Britain's Prince William and Prime Minister Boris Johnson led a chorus of voices condemning online racism aimed at some of England's black soccer players. That's after the national team's defeat in Sunday's European Championship final. The episode follows weeks of controversy over whether the England players should have been supported in taking the knee before games in response to issues of discrimination and racism. Johnson addressed it in a news conference on Monday.
To those who have been directing racist abuse at some of the players, I say, shame on you. This entire team played like heroes.
Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura writes here in London. Now, Joshua Schaffstein, Johns Hopkins Bloomberg School of Public Health Vice Dean, discusses risks around, or has been discussing with us, the risks around the COVID-19 Delta variants and the urgency to vaccinate more people. Let's get an update.
There are parts of America that are 40% vaccinated or 35% vaccinated, and those are the parts which are now seeing not only an increase in cases, but an increase in hospitalizations due to the Delta variant. So, you know, it's like, here we go again in those places. And, you know, it's really important to be vaccinated there, but more generally, it reflects a big problem that we're having.
Okay.
Having people ready for the vaccine.
I get that, but what do we do in the parts of the country that are 60, 70, or even more percent vaccinated? Do we just go on with our lives, or do we have to amend our lives because another part of America is down at 38%?
Well, as long as there are places that are at 38%, the places that are at 70 or 80 are going to be at risk. Now, the people who are vaccinated right now are pretty protected, but what about people who have conditions that, the vaccine doesn't work so well for them? They're immunocompromised, for example, or children, or, some particularly older adults.
Dr.
There are
Sharfstein.
risks to people, even if they're vaccinated in some cases.
I apologize to interrupt, but this is a really crucial point that I really haven't heard before. The vaccine does not work for certain individuals. How many people are we talking about?
Well, there are probably, hundreds of thousands, if not maybe a little bit more than 1 million, something like that, who have such significant medical conditions that they're just not going to react to the vaccine. It may even be more as you consider people who are on immunosuppressive drugs. We don't know exactly how much risk they're at, but it looks like they're not responding to the vaccine as well, and some people may not be responding at all. So they have to worry that they're going to come in contact with somebody who is infectious. Now, if you're in an area without very many cases, that risk is low. But as long as the virus is really spreading in parts of the country, that risk is going to be there.
Dr. Sharfstein, I think the confusion also stems from the uncertainty around what the threshold is to return to normal life. I know the United Kingdom is struggling with this as well. Does it become, as John has talked about, a public health issue when we have individuals who might suffer, but as a whole, the healthcare system is not going to be torpedoed by a flood of cases?
Well, I think it matters that, the healthcare system is going to be stable. I think that does allow for, a lot of things to return to normal. But it still makes it unfortunate for people who have to take extra protections if they're doing that because, other people haven't decided to be vaccinated. It's even worse for the people who haven't decided to be vaccinated because they're at risk for getting very sick or dying.
How close are we to an under 12 vaccine?
I think you have to wait for the studies to be done. Right now, the companies are looking for the right dose to make sure that, they have a dose that is both able to create the protection, but without, side effects. And so until we see the data, it's hard to say. Those studies are going on, and I think we'll have probably the early readouts in the next couple months.
That was Joshua Sharfstein, Vice Dean of the Johns Hopkins Bloomberg School of Public Health, giving his perspective and focusing on the US vaccine rollout there. I should say that the Johns Hopkins Bloomberg School of Public Health is supported, as the name suggests, by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. We'll get back to the markets conversation next. We'll keep an eye on lines coming through from the Financial Stability Report at the Bank of England as well. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it, people who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Again.
Broadway's returning June.
If you bought tickets,
it's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
No. Beautiful. Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Welcome back to the European Market Open this Tuesday morning, 40 minutes into our trading session, and we're flat on the Stocks Europe 600. A mixed picture for the banking sector. The FTSE 100 moving higher on that, up by 0.3%, and also a rebound in basic resource stocks. The DAX and the CAC fairly flat, but a little bit of downward bias. I just want to mention some of the lines coming through from the Bank of England. We do have a press conference taking place, the Bank of England governor at least speaking about the financial stability report. We brought you all the news lines from the report itself about an hour and 40 minutes ago when they dropped on the Bloomberg terminal. And now we do have this press conference taking place. We don't have pictures of it, but we can tell you some of the lines coming through. Nothing new to add really to what broke at 7 o'clock, except that Governor Bailey has said the UK economy is recovering, but risks remain. We will, of course, keep an eye on those pages on the Bloomberg and see if anything new emerges. Let's get a Bloomberg Business Flash. Top corporate stories this morning. Here's Laura.
Thanks, Anna. Blue Origin has secured a license for human space travel from the FAA just days ahead of the scheduled launch on July 20th. The launch will happen 9 days after Richard Branson's Virgin Galactic successfully executed a key test for space tourism. More problems for the Boeing 787 Dreamliner. Bloomberg's learned the company has uncovered an additional manufacturing problem with the plane. It has to do with the forward pressure bulkhead in the 787's nose. It's not considered a threat to flight safety, but Boeing has halted deliveries of the plane in May. Regulators are looking at tiny imperfections that have cropped up on the lining of the jet's carbon fiber airframes. Disney has been investing heavily in new packages of sports rights, and viewers will pick up the tab. The company is raising the price of its ESPN Plus sports streaming service by 17%. It will go from $6 a month to $7. ESPN Plus is the smallest of Disney's streaming services. It has 13.8 million subscribers, and perhaps Anna Edwards is one of them as a big sports fan.
Yeah, I'm not sure how wide-ranging my appreciation of sports is, Laura, but I can certainly get behind a big event. Laura, thanks very much. Laura Wright with the Business Flash here in London. Let's take a look at some of the things that are on our radar today. It could be a busy one in terms of US data at least, and the US banking season, because at around 1 p.m, JP Morgan Chase kicks off banking second quarter earnings season. Then at 1:30 p.m, we will have June US Consumer Price Index. Of course, all these times are UK times, even for these things taking place in the United States. That US CPI number really will be a focus for the day. Later today, we'll have the Bloomberg Live presenting a particular event, the Sustainable Business Summit Global, a virtual event which brings together business leaders and investors globally to drive innovation and scale best practice in sustainable business and finance. Plus, the Atlantic Council hosts a conversation with the WTO Director General, Ngozi Okonjo-Iweala. That's on the future of trade in a post-COVID-19 world. Lots to keep our eyes on them, and Ven Ram from our Markets Live team will be keeping his eyes on the US CPI data that I just mentioned. Ven, good morning. Forecast to be its highest since 1991. Expectations for a big jump in CPI. That's not the whole story, I suppose.
That's definitely not the whole story, Anna. Look, I mean, we've had these outsized CPI trends in the past couple of months, and we have seen that, you know, despite those higher trends, we haven't seen U.S. rates tick higher. And Yeah, and consequently, real yields have trailed as well. And at the moment, real yields are like minus 1%. In an economy that's forecast to grow like 7% this year, that's the fastest in decades. How do you explain real rates that are so anemically low? And that poses a quandary for traders. And that means that today's inflation print, unless it's really out of the ballpark of economists' expectations, it's unlikely to do much more to inform us about this debate as to how yields should evolve in the U.S.
You're focused on real rates, and you mentioned real rates there. I'm just looking at nominal rates here, 1.36%, the US 10-year yield. And we've seen quite a lot of auctions this week, and a lot of auctions having to be fitted into just a couple of days because we've got Jerome Powell testifying later on this week, Ven. The auctions seem to go well. Do we learn anything from the level of demand we've seen there, the recent moves in Treasury prices?
Well, I mean, I'm not surprised that the auctions have gone off relatively well. I mean, look at 136. It's not great, the rates on 10-year treasuries, but if you look at it in comparison to the rates elsewhere in the world, you've got German bond yields at minus 0.3%. You've got Japan GJB yields that have gone nowhere and that are so low, so incredibly low. Against that backdrop, for an investor and a fund manager, you've got no choice but to kind of support treasuries, and that's what we see is going on.
And let me ask you about your piece you wrote this morning, because I love the title of it. Rising stock valuations like Pinocchio's nose dare traders. You can explain to me the Pinocchio reference, but I think it's interesting to think about where we are on these risk assets right now at a time when I think it was Morgan Stanley warning just overnight about the valuations that they see certainly on price metrics. They're very concerned about price to sales, I think it was, metrics. They're concerned about valuations in the tech sector looking, in their view, very similar to the dot-com period.
Yeah, I mean, I'm not surprised at all. I mean, if you look at the S&P at the moment, it's a forecast nominal earnings yield is about 4.4%. Well, I mean, if you look at the history of U.S. stocks, except during the dot-com bubble, that kind of earnings yield has never been so low. It's been 5% plus pretty much the entire history of the S&P going back in a long time. So at the moment, the nominal earnings yield is so low because treasury yields are low, and therefore the discount rate applied on stocks is low. And you can kind of explain as to why stocks are so overvalued, so richly valued. But how long is that going to continue, and how long is that going to be sustainable? If the Fed starts tapering and starts raising rates eventually, the discount rates applied to stocks must necessarily go higher, and that will act like a gravity, like a pull of gravity on stocks.
I see. And just like Pinocchio's nose, then, US stocks seem to have a tendency to extend and rise forevermore. So says Ven Ram at the Markets Live team. Thank you very much for joining us. Ven Ram from the MLive team. MLive Go is the function to use to get up-to-date thoughts from Ven and the rest of the Markets Live group. Coming up, big dividends from European banks may be off the table after an ECB official said the central bank could take steps to stop excessive payouts. There's a bit of a contrast then between the ECB and the lines we've heard so far from the Bank of England. We'll pick up on that next. This is Bloomberg.
households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Those resilient hydrocarbons are the engine of the transition. Rosneft is the epitome of resilient hydrocarbons, both from a cost perspective and from an environmental perspective. Rosneft is an absolute core part of our company and our strategy.
That was the BP CEO, Bernard Looney, speaking to Bloomberg on the importance of hydrocarbons to its green energy transition. You can hear more of that conversation. The full conversation will be broadcasting at 1 p.m. UK time as part of Bloomberg's Sustainable Business Summit. That is taking place this week. 51 minutes into our European trading day then, and let's have a look at some of the market moves that we're seeing this morning. We've got a fairly flat picture overall, but the FTSE 100 being lifted by basic resources, which moved to the upside, but also the banking sector. And here we have a bit of a divergence between what's going on between UK banks and banks in the Eurozone, because the ECB line on this is different overnight. So here's the UK banking story for you, and we'll show you the response we're seeing in UK listed banking share prices, all moving to the upside by more than 1% on this particular board. And this is partly because the Bank of England has said this morning that it will lift the restrictions on banks' ability to pay out dividends. The ECB will do something similar later on this year, but it is also suggesting that banks shouldn't pay something more than average dividends. And so there remains a little bit of emphasis on restraint in the ECB case. We are getting some further lines coming through from the Bank of England this morning as we watch the financial stability report. So the Bank of England's Andrew Bailey talking about those dividend restrictions and saying they were the right policy for 2020, and perhaps that's partly the justification for removing them now. And we're also getting lines from the Bank of England's Sir John Cunliffe, who's the Deputy Governor for Financial Stability. So this is his area of focus, and he is watching the housing market closely, is not complacent, is keeping a close eye on the link between house prices and debt. The Bank of England has not really rung alarm bells around the UK housing market, partly because interest rates are so low in the UK right now, despite the big pickup that we've seen in demand for housing in the UK and also elsewhere. So that's the central banking story and the impact it's having on the banks this morning. Let's broaden the conversation, get a Bloomberg First Word News update. Here's Laura.
Thanks, Anna. White House officials are discussing proposals for a digital trade agreement covering Indo-Pacific economies as the administration seeks ways to check China's influence in the region. That's according to a Bloomberg source. Details of the potential agreement are still being drafted, but the pact could potentially include countries such as Canada, Chile, Japan, Malaysia, Australia, New Zealand, and Singapore. French President Emmanuel Macron turned up the pressure to get vaccinated. He said getting the COVID shot will be mandatory for healthcare workers, and so-called health passes, which show proof of negative tests or vaccination, will be obligatory in venues like restaurants and cafes.
Pour nous protéger et pour notre unité.
For our unity and protection, we must aim to vaccinate all French people, because this is the only way to return to normal life.
Le pass sanitaire s'appliquera.
From early August, the health pass will not only apply in cafes, restaurants, shopping centers, hospitals, retirement homes, and medico-social establishments, but also in planes, trains, and coaches for long journeys. Only the vaccinated and people who test negative will be able to access these places.
Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Thanks very much, Laura Wright here in London. Interesting to see then such extensive use of the pass sanitaire, the health pass in France, to access all of those parts of daily life. And in that context, of course, that the aim of that is to drive up vaccination rates in France. And thinking about where we've got to on vaccinations across Europe, we're hearing from Ursula von der Leyen this morning, who is talking about how more than half of all adults in the EU are now fully vaccinated. She says to keep safe from variants and avoid a new wave of infections, it is important to get vaccinated. The EU has enough doses, enough doses have been delivered to vaccinate 70% of adults, she says, in the EU. So let's do it, a big focus, a big push on trying to vaccinate more people across Europe. Now, the European Central Bank looks to be taking a different approach from the Bank of England when it comes to dividends. It could take steps to ensure that lenders avoid paying excessive dividends later this year. Let's get more on this. So Bloomberg's Maria Tadeo has the details. Maria, good morning. Give us the latest.
Yes, Anna, and look, this is back to an interview that we've done with Margarita Delgado. She is the deputy governor of the Bank of Spain. She is also a member of the supervisory board at the European Central Bank. And funnily enough, I'm sure you remember, she was also a bank executive before she moved to the central bank. So what she says and argues is that the ECB will be paying very close attention to banks that perhaps are looking to pay excessive dividends. Of course, what is an excessive dividend remains to be seen. She says that there's a number of measures that the central bank could take and could look into if that was the case. Of course, these words are probably not going to go down well with banking CEOs and executives in the European Union who feel that for now and for a while now, it's been almost impossible to become attractive for shareholders, given the fact that you have negative interest rates, the fact that, you know, you're also not able to pay as much as you would pay if you're a U.S. bank, so it's hard to compete.
Yes, hard to compete, and I see European Eurozone-listed banks underperforming those in the UK, certainly this morning, and other European non-Eurozone-listed banks this morning. Thanks very much for joining us. Bloomberg's Maria today with the latest on the banking sector across Europe. That is it for the European Market Open. Surveillance Early Edition is up next. They'll continue to monitor the press conference at the Bank of England. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
This pandemic is not over. This disease, coronavirus, continues to carry risks for you and your family.
We must aim to vaccinate all French people because this is the only way to return to normal life.
I have not seen the evidence yet that would make me feel that it is appropriate to vaccinate the entire population with a third dose.
This is Bloomberg Surveillance, Early Edition with Francine Lacroix.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Tuesday, the 13th of July. I'm Francine Lacroix here in London, and here's what's coming up on today's program. Now, of course, we start with Britain's biggest banks. They will be freed from the BOE's pandemic restrictions on payouts. Meanwhile, the ECB actually warns excessive dividends for European lenders may be off the table. President Biden's team are weighing up the idea of a digital trade deal to counter China's influence in the Asia-Pacific. An agreement could lay out standards for the data trade and electronic customs. And the EU announces that over 50% of people in the bloc are fully vaccinated. This, as UK scientists warn the country could see as many as 200 deaths a day at the next virus peak. So good morning, everyone. Quite a lot going on, especially with virus news. As earnings, though, we also look at banks. As earnings season begins, the European Central Bank may actually move to ensure lenders avoid excessive dividends. Now, the bank wants lenders to remain cautious. That's according to Margarida Delgado, a member of the ECB's supervisory board. By contrast, the Bank of England has removed restrictions on banks' dividend payout. So for more on all of this, joining us now is Bloomberg's UK finance reporter. He's Tom Metcalf. Good morning to you, Tom. So first of all, why did the BOE actually decide to lift dividend rules now?
Yeah, so they came out with this report this morning, and basically what they're looking at is these stress tests these interim stress tests they've been carrying out on British banks, and they're also looking at the wider picture. So they said they drew quite a lot of solace from the vaccination program that's being rolled out across the UK, and with those two elements, they felt that the banks that they sort of regulate are strong enough to effectively have their decision making restored to them for dividend payouts. So that's their reasoning, but as you pointed out, it's a lot less cautious than the EU.
Yeah, so as we also go into earnings season, Tom, first of all, does this give UK banks an advantage over the EU peers?
I think it's definitely a positive, obviously, for investors. So at the open, you saw, British banks jump, 1-2%. And for a long time, this sort of restrictions on payouts has been what, executives of banks have sort of been railing against. So it's certainly a positive. On the EU side, it seems that it's more of a sort of delay, so only a few more months, and then they'll be allowed to do something similar. But certainly for now, it's a positive for the UK banks.
Do we know why, Tom, the EU is actually a lot more reluctant in paying out dividends now? I mean, if it's only a couple of months, does it actually make that much of a difference? Or is there a real fundamental shift difference between the two central banks?
Yeah, they're looking at obviously a different region, and whether institutionally they might be more conservative. It's kind of interesting when you look across the world. The US certainly the most kind of aggressive in restoring the ability to pay out dividends, and the UK has now followed up. It's hard to say exactly why. And to be fair to the Bank of England, they did include some cautious messaging. So they were saying to the banks, like, look, we're letting you pay dividends, but you've got to make sure you continue to support, borrowers who might be facing difficulties. And also we expect, these dividend policies to be reasonable and not sort of completely, pay out all your capital or something like that on these things.
Thank you so much, Tom Metcalf, there, our Bloomberg UK finance reporter and editor, joining us this morning. Now, coming up, as Europe hits 50% of adults fully vaccinated, the story is different in emerging markets. So we'll speak to EM specialist Jakov Arnopolen. Next, stay with the early edition, because also a little bit later we'll be joined by the DNB Chief Executive, Kerstin Bratten, and the Consob Commissioner, Carmine Di Noia, this morning. So we have you covered when it comes to banks and capital markets. If you have any questions for the guests, please just write into IB Plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition, and I'm Francine Lacqua here in London. Now, let's get to one of our top stories, and the European Union puts on hold its digital tax plans. The EU has actually faced intense U.S. pressure to try and postpone any announcement until a deal among the G20 members can actually advance. A proposal was expected later this month, but of course the announcement comes after U.S. Treasury Secretary Janet Yellen also arrived in Brussels for meetings with EU officials. So for more on all of this is Bloomberg's Enda Kern. Enda, thank you so much for joining us. You always give us great perspective from the Asian front and actually what that means for Asia. What is your biggest, I mean, if you look at the digital economy, how many more deals can we see, for, including Asia?
Well, I think, look, one of the big takeaways or talking points today is this idea of a digital trade deal that the US are talking about in terms of countering China's weight in Asia, Francine. Now, we don't have full details on it yet. Our colleagues in Washington were reporting this out, but the kind of framework of it is that it could set standards for the digital economy. There could be new rules for the use of data and trade facilitation and electronic customs and the like. So it would be twofold. It would be both an economic arrangement, of course, between the big economies and the US, and it would certainly be another indication of how the Biden administration is reaching out to the rest of the world to build alliances, and certainly would be an economic and strategic step forward for the administration, I think, in the broader Asia-Pacific region, Francine.
And how quickly could that actually be put in place, and how much of a difference does it make to economies?
It's difficult to say. I mean, at such early stages, we know that, for example, the TPP took quite a long time, and then the US eventually pulled out of it. But this is obviously a different order of magnitude. This kind of agreement, it may not take as long. There's probably an appetite there to get something on the board pretty soon, given the acceleration of the digital economy during the pandemic, for example. I think a lot of governments would welcome some kind of a rules-based agreement in terms of how we can handle this new economy that's emerging all around us. But at the same time, it will be complicated, it will be challenging. We have some experts who are saying that it won't be as straightforward or fair, Francine. So while it probably won't take as long as the TPP did, it certainly may take some time before all of the nuances are ironed out that every government can agree to and sign on to.
And there's also a story that's been reported by the FT, which feels very significant, which is, the American president basically telling companies to be careful in Hong Kong, or telling them about the increasing risks of operating in Hong Kong. What does that mean for Hong Kong as a financial hub?
Well, indeed, we'll have to wait for the details. This is a Financial Times report today making the point that they will be warned, as you say, American companies will be warned of some of the risks of operating here. I guess at the very least, you'd have to say it speaks to another step by the US government to crack down on China after its own crackdown on the democracy movement in Hong Kong. It's kind of an indication that those tensions haven't gone away. Of course, we had US moves against China and Hong Kong last year as well, include some sanctions and some export control orders and the like. So this is kind of another step in that front. As I say, we'll have to wait for the details to come out of Washington. But, at the very least, it does speak to the fact that the US has not yet taken its eye off of Hong Kong. I should say that China, of course, has already refuted the report, and they say that Hong Kong is China's own internal affairs, and they push back against any external criticism.
And thank you so much, Bloomberg's Enda Kern there in Hong Kong for us. Now let's talk a lot more about the virus and, of course, what's going on with the virus in some of the emerging markets. Countries are racing to vaccinate their populations as a more contagious Delta variant spreads around the world. Now, here in the UK, scientists are estimating that England faces up to 200 deaths a day after restrictions end next Monday. The problem, of course, is significantly worse in less vaccinated emerging markets. Deadly waves of the coronavirus in India and Brazil, an outbreak in Southeast Asia, are now shutting down a population twice the size of the U.S. Indonesia, the region's largest economy, has also seen daily traffic down 21% this month after movement restrictions were placed on the islands of Java and Bali. Now, joining us now to talk about this is Jakov Arnopolen. He's Emerging Market Portfolio Manager at PIMCO. Jakov, thank you so much for joining us. You always make us wiser and smarter on what exactly is going on in emerging markets and how we should look at them. Before we get into anything else, there's a different vaccination drive depending on what emerging markets you're talking about. So what does that mean of how you play these emerging markets?
Sure. Good morning, and thanks for having me. I think, as you pointed out, there is a lot of disparity in terms of the pace of vaccination among different emerging market countries, as well as the prevalence of some of the Chinese vaccine, where there are some doubts as to its efficacy. Realistically, if we look across the spectrum, the 5 or 6 countries that stand out in terms of being the most advanced in terms of their vaccination rates are UAE, Israel, Bahrain, Chile, Serbia, and I think what am I missing? But let's start there. The reality is, although these countries are certainly far in advance of the pack of the rest, we haven't really seen a clear connection between their advanced vaccination programs and asset prices. You know, we talk a lot about emerging markets being condition takers, very much dependent on what's going on in the US, what's going on in Europe. So realistically, we've seen, let's say, the reflation, the reopening in the US and Europe have been much more impactful in terms of driving emerging market beta, emerging market returns, than necessarily some of the idiosyncratic advances.
Yeah.
So we can say that the market has punished the countries that have lagged, India, South Africa, but hasn't truly rewarded the ones that have been ahead of the pack.
So is that why, if you look at stocks, for example, Yakov, is it also why some of the emerging markets kind of didn't take advantage of what's going on in the US with the reflation trade?
Yeah, look, I'd say it's been a mix, right? It's been a mix of flows, a large component of returns of stock market indices are currencies. Post FOMC, with this big rotation in markets, in treasury markets, in stock markets, we've seen some of the EM currencies, EMFX, underperform, which also has impacted returns. Again, when we kind of think about what is a benign environment for EM versus what is kind of more adverse environment for emerging markets, what we see time and again is these periods of adjustment, when you have big moves in market, big moves in rates, tend to produce a wobble in EM as well. It's actually interesting if you think back to February and March, rates repriced higher in the US and the rest of the world, EM underperformed. Then with a period of stability, the dollar weakened, EM produced pretty solid returns. Then again, post FOMC in June, we're seeing another wobble as rates actually go in the opposite direction, but just this volatility ends up being, it's a headwind for EM. So we need some stability in rates. Whether the rates are higher or lower, that's fine. We just need them to settle down.
But Jakob, given the slide we saw in US yields, does that actually change the narrative about the emerging market tightening cycle?
Great question. So, look, I'd say we're still seeing quite a few EM countries that are doing some heavy lifting in terms of rate hikes. When I think of Brazil, when I think of Russia, right, these countries are far ahead of the rest of the world, certainly far ahead of the US and Europe in terms of their hiking cycles. And in fact, that has led us to reposition our portfolio somewhat, because when we think of FX, when we think of currencies, this is actually a ripe environment for relative value for pair trades. So we've been favoring countries, the hikers, so to speak, currencies of Brazil and Russia, the ones I mentioned, and pairing them with underweights or with shorts in countries that are not hiking rates, that are behind, places like South Africa, places like Poland.
All right, Yakov, thank you so much. Yakov Arnopoling there from PIMCO stays with us. And also apologies, I think you heard my lockdown puppy in the middle of it chasing a cat. He thinks he's in the Mission Impossible movie. Coming up, inflation considerations. U.S. CPI for June is due out later today. The print, is it going to be red hot or a red herring? We'll discuss more with Yakov Arnopoling from PIMCO. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. French President Emmanuel Macron is toning up the pressure to get vaccinated. He said getting the COVID vaccine will be mandatory for healthcare workers, and so-called health passes, which show proof of negative tests or vaccination, will be needed in venues like restaurants and cafes. And here in the UK, Prince William and Boris Johnson led a chorus of voices condemning online racism aimed at some of England's black football players. This comes after the national team was defeated in Sunday's Euro 2020 final. The episode follows weeks of controversy over whether the England players should have been supported in taking the knee before games in response to the issue of discrimination and racism. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, the shifting sands of global inflation will focus, of course, central bankers from Ottawa to Wellington in coming days after a month of mounting concern about consumer prices. Central banks in Canada, New Zealand, but also South Korea will announce rate decisions this week. And, of course, the key data point will be the June CPI print due later today in the United States. Even as bond markets reprice the inflation trade, as the reopening narrative continues to dominate, today's number could actually show little change from a previous red-hot print on 5%. Well, still with us is Yakov Arnopoulin from PIMCO. Yakov, what do emerging markets actually need from the Fed right now?
Sure. Look, we'll see what the U.S. CPI print brings. Our view is that ultimately, even if it's still fairly high, and even if year-on-year inflation is north of 4%, we're still kind of past peak inflation. But I think that kind of takes us back to my earlier comments, which is we need some stability in U.S. rates. Whether it's higher on the 10-year because we're continuing to see inflation, I think that's totally fine. Again, EM can benefit from that momentum. Whether the 10-year is actually settles around here, 135, 130, I think that's also kind of comfortable level in that the yield starvation narrative will come back. We'll get the return of the crossover bid to emerging markets. I think we just need rates to settle down a little bit, right? People were looking forward to a quiet summer. It's been anything but. So we'll see what the CPI print brings. Obviously, the next milestone is going to be non-farm payrolls in early August, then Jackson Hole. I think kind of ultimately this is not narrative shifting, for emerging markets. And we're still of the view that the reflation trade is alive. And in fact, you could see it overnight with the China export number, which was quite punchy.
Yakov, overall, I mean, we saw a less hawkish stance, or China actually breaking away from the rest of the hawkish central banks and doing, accommodative measures. What does that mean for emerging markets? Will others have to follow suit?
To us, what happened in China with the surprise triple R cut doesn't really change the direction of travel with regards to kind of some contraction in the fiscal impulse with the second half of the year, probably kind of bringing it a contraction of 5-6% in the fiscal, in the credit impulse in China. We still view that they'll continue to tweak things. So they're trying to thread multiple needles. They're trying to ensure they provide financing to SMEs, to small and medium enterprises. They're trying to provide financing to the manufacturing center while reducing the credit flowing into the property sector while reducing credit flowing into infrastructure. So it's almost, they're under the surface, the policy measures are really designed to kind of tweak and channel the flow of credit to particular sectors to balance out the economy. So to me, this is very China-specific, may not actually kind of spill over into broader emerging markets for now. But sorry, back to this expert print, which I think
Jakob,
matters.
Yeah.
Just very quickly, back to the inflation print. What it speaks to is rather, it's probably the strength of other economies that are buying goods from China, whether that's U.S., Europe, or emerging markets, Asia. Again, so that's further evidence of the
So,
reflation
Jakob, given
trade.
all of this, what are your favorite picks right now?
Sure. We're still of the view that kind of stick to names that have very safe balance sheets, provide very solid carry, and when this crossover bid comes back, will be favored by investors. Now, what countries come to mind? I'd say Romania in the hard currency side. Jordan has very solid geopolitical support. Places like Morocco and you can add Dominican Republic. So this kind of mix of triple Bs and double Bs that have underperformed recently, but certainly provide robust yield, robust balance sheets.
Okay, Jakob, thank you so much for joining us today. Jakob Arnopolling, their emerging market portfolio manager at PIMCO. Now, coming up, a lot more coming up ahead right here on Bloomberg. Norway's reopening optimism actually leads a bank, DNB growth, in all areas, but margin pressure on the nation's banks remains intense. So up next, we speak to the DNB chief executive, Kirsten Bratin. Then we also look at all of the emerging markets. Well, we were just talking with Jakob Arnopolling of the emerging market moves. We'll talk at UK banks freed from the BOE's pandemic dividend restrictions. We'll also talk that CPI print out of the US. Future steady ahead of earnings and inflation data as well. This is Bloomberg.
Up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Britain's biggest banks will be freed from the BOE's pandemic restrictions. This was announced today on a payouts. Meanwhile, the ECB warns excessive dividends for European lenders may be off the table. President Biden's team are weighing up the idea of a digital trade deal to counter China's influence in the Asia-Pacific. An agreement could lay out standards for the data trade and electronic customs. And the EU announces that over 50% of the people in the bloc are fully vaccinated. This, as UK scientists warn the country could see as many as 200 deaths a day at the next virus peak. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition on this Tuesday, the 13th of July. Now, let's quickly check on the markets because there is quite a lot going on. Various forces at play. First of all, we see the banks kind of on the move after the Bank of England said that they were free to pay dividends and payouts. We're expecting also a decision from the ECB. That could be delayed by a couple of months. What the markets want to know about is earnings. We start having the big U.S. banks coming out with earnings a little bit later, but also inflation data. So traders really awaiting that key American number. Second quarter earning reports also from some of the world's biggest banks will give us an indication on how they're worried or not about inflation pressures and how they're worried about the Delta variant. Treasuries and the dollar pretty much steady. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Blue Origin has secured a license for human space travel from the FAA days ahead of the scheduled launch on July the 20th. The launch will happen just 9 days after Richard Branson's Virgin Galactic successfully executed a key test for space tourism. Now, more problems for the Boeing 787 Dreamliner. Bloomberg has learned the company has uncovered an additional manufacturing problem with the plane. It has to do with the forward pressure bulkhead in the plane's nose. It is not considered a threat to flight safety. Boeing halted deliveries of the plane back in May. Regulators are looking at tiny imperfections that have cropped up on the lining of the jet's carbon fiber airframes. Disney has been investing heavily in new packages of sports rights, and viewers will pick up the tab. The company is raising the price of its ESPN Plus sports streaming service by 17%. It'll go from $6 a month to $7. ESPN Plus is the smallest of Disney's streaming services. It has 13.8 million subscribers. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, DNB Bank sees increased customer activity and optimism in line with the reopening of the Norwegian economy. After a very good first quarter, the bank's financial performance has been further strengthened in the second quarter, partly as a result of the nation's solid household liquidity. Well, joining us now is the DNB Chief Executive, Kirsten Bratten. So thank you so much, Kirsten Bratten, to come on Bloomberg TV on such an important day. First of all, when you look at the strength of the banking sector and your bank in particular, do you worry about inflationary pressures suddenly taking hold?
We do not see a particular uptick in inflation in Norway. On the contrary, we see a healthy growth and a healthy growth in both activity and employment. We are in fact closing already onto unemployment levels that are close to pre-pandemic levels, and we certainly qualify the growth that we see in the economy as healthy. Our central bank has also stated that they are expecting to start commencing rate hikes as soon as September, with an additional 4 rate hikes towards the end of 2022, and a total of 7 towards the end of 2024. So this is underpinning a positive development and a future positive expectation for the Norwegian economy, which is important for our business.
I mean, margin pressure remains pretty intense after rate cuts last year. Do you expect policy rates, or policy to be hiked in the second half, and that would it directly actually transmit to a higher net interest margin for the bank?
We have, in the recent quarter, upheld our margins well across both the personal sector and the corporate sector, and see healthy loan growth across all of the areas of the business. One of the particularity with the Norwegian banking market is that we have primarily floating rates. So once rates start to hike, the impact on our rates would be seen through a possible repricing in the markets. So we cannot talk about the future, but if we look historically, this has typically been what has happened in the Norwegian market, that once the central bank starts to hike rates, rates are adjusted from banks. And increasingly, it is a competitive market, but it's also a very rational banking market in Norway.
Fees were pretty strong in the second quarter. I think they were up some 20%. Is that something that's sustainable longer term, or was it an immediate effect of Norway reopening?
We had strong fees also in the first quarter, and the second quarter are seasonally strong in fees, but it is gratifying to see that the work that our organization puts in leads to an all-time high level in fees and a growth of 20%, as you're pointing out. We have been specifically targeting for the past years to build and grow faster on the fee side than on the interest income side, and we see higher fees, a broader geographic spend on our investment banking revenue, as well as a broader number of sectors being represented. So we are getting more out of an active market. Another sector that I would like to highlight is the asset management and the saving market, where we've recently had a pension reform in Norway, and we see an increasing interest both from retail, or in particular from retail investors, to invest in fund and shares in addition to more traditional savings. And in these areas, we see volumes actually being up by 50% compared to the same time as last year. So part of this is certainly recurring and resilient business, but there's also some dependence on market activity. But overall, we're getting more out of an active market.
Would you tell us if you're able to counter some of the wage inflation with other cost initiatives at the bank?
We are working very high on cost initiatives consistently, and we are running what I would define as an efficient operation, targeting a cost level of our cost being less than 40% of our revenue. At our Capital Markets Day a couple of years ago, we stated an ambition to reduce costs gross by 1.5 to 2 billion, and we are progressing according to plan. But we are also investing into the business. So the cost savings have the function of neutralizing part of the investments we are doing to the business. But we are committed to the target of less than 40% and believe that is within reach towards the end of 2023. But our most important target is return on equity, where we're targeting minimum 12%, and running an efficient business is necessary and important to support that, and we will continue to work hard on cost.
DNB is very big in the shipping, of course, industry. The EU on Wednesday will unveil its latest plans to become carbon neutral, and that includes transportation. Depending on what they say, although we do already have a couple of details or leaks, how does that impact the industry?
It means that the industry needs to restructure and reduce emissions, which we feel that the industry is already on the path of doing. We stated a few months earlier that we are committed to and supporting the net zero ambition by 2050. And further, this quarter, we have upped and set targets on how much we will support the growth in renewable energy and alternative energy that is needed both for shipping and other parts of the economy. And we have also set specific targets for the indirect reductions that we will measure on our portfolio in several areas, amongst others on the shipping side. We have started to measure emissions indirectly from our maritime portfolio and actively work with our customers to ensure that those reductions are going towards the targets that we have set.
So how does it actually filter through the bank in terms of bottom line or revenue?
Well, the underlying ambition for everything that we do is that our business should be profitable. Now we believe sustainability goes hand in hand with strategy and profitability. So that lies in the basis. With regards to the maritime industry, where we have a world-leading position, we've actually, together with a couple of other banks, constructed what is called the Poseidon Principles, which is the EU taxonomy for maritime, you can call it. So in this way, we have already started to measure the emissions that comes indirectly from our exposure to these customers. We're actively working with the customers on their plans to reduce emissions. We are increasingly doing financing that are sustainability linked. For instance, they will get better terms if they deliver on their plans to reduce emissions. And then we will have to follow and measure as time goes ahead to see that the portfolio actually reduces in accordance with the targets and the ambitions that we've set. But we will not seize on our requirement that all business should be profitable.
Kirsten Bratten, thank you so much for joining us today. She is, of course, the Chief Executive of DNB. Now, coming up, Mancunians cover a Marcus Rashford mural with supportive messages after it was vandalized following England's defeat against Italy in the Euros final. Boris Johnson condemns racist attacks against footballers. Up next, we discuss racism in football. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
To those who have been directing racist abuse at some of the players, I say, shame on you. This entire team played like heroes.
Well, that was the UK Prime Minister Boris Johnson condemning racist abuse against footballers following England's defeat in the Euros final. Bloomberg opinion columnist Therese Raphael says this might be too little too late. In her latest opinion piece, she says Boris Johnson was given and missed a golden opportunity by Gareth Southgate to take a bold stance against racism, and he missed it. You may read, and you should read, actually, the piece in full on OPIN Go on the Bloomberg terminal. Well, joining us now is Therese Raphael to talk about this very important subject. Therese, first of all, talk to us about why you think Boris Johnson missed. He should have, cracked down, I guess, on racism in football a lot earlier.
Obviously, football has had a racism problem, not just in England, in many countries for some time. So this isn't anything particularly new. And in some ways, it could have been anticipated and was by Gareth Southgate, who took a very courageous decision early in the Euros when, many people were not expecting England to do as well as it did. To have his players take the knee. And he was very clear that that decision was not a political statement. He wasn't signing up to anything more than a statement against racism. It was, as I said, it was a risky move by Gareth Southgate because given how controversial taking the knee is, given the controversy around it in the United States, it would quite probably be misinterpreted by some fans, and it was. But Southgate persisted. He explained it. He said, "This isn't a political move. It's not a political. It is a simple statement against racism." And the government's reaction, Boris Johnson's reaction, that of other Tory officials, was immediately to distance themselves from that. Some were very critical of it, including the Home Secretary, Priti Patel. And I think that's really backfired. It has come out now as they're condemning the racist abuse that has been hurled at these three England players who missed their penalty shots. The condemnations now seem a bit shallow. I think we have two leaders here, Southgate and Johnson, and one took a very courageous move because the upside in signaling that racism is abhorrent and weighed the risks he had in losing supporters. And the other took a more calculated political decision to try to split the difference. And I think that's where Boris Johnson went wrong here.
And in your opinion piece, which is once again hits the mark, beautifully written, you also say that Tyrone Mings was completely right to call out the Home Secretary on her double standard. Today, what does the government need to do to basically make sure that this doesn't happen again? Is there something that they can do now, or is it a little too late?
No, I don't think it's too late at all to take concrete action. And that's probably, the only thing that can be done that really shows the government is serious about tackling this. I mean, there's, one of the longstanding growing problems is abuse on social media. That's what we've seen in the wake of the England final. What can be done about that is going to be more coordination with platforms, not simply to play whack-a-mole and ferret out the odd abuser with so many still going through, but really to coordinate a response that sees, whether it's identification checks, whether it's more enforcement, but the name of the game now has got to be enforcement and tougher laws. And I think that's where the government will have a chance to show how serious it really is in backing the England team and backing Southgate and in backing all those who've been so courageous in fighting racism in the country. It can't be done without official support, and that will require more than just the rhetoric we've seen in the last sort of 48 hours.
Right. So more than tweets, is it actually banning people from football matches?
Yeah, absolutely. Banning people from football matches, stadium bans, kicking teams out. I mean, we've seen this throughout international competition. The problems have been brewing for a while. Bulgaria, Italy's had problems. France has had problems despite this great World Cup win in 1998, which was, many people thought would be a giant leap forward in terms of helping eradicate racism in the sport, and they found that it wasn't. So it takes constant vigilance from the footballing authorities, for sure, from the club level all the way through to the international level, from the government in terms of the regulatory side and the legal side, and from the tech companies, which again is going to require government involvement. But there has to be a sort of zero tolerance, and that's where I think the government made a mistake here. There was language that encouraged both sides.
Therese, thank you so much. Our Bloomberg opinion columnist, Therese Raphael, and you can read, of course, her full piece on the terminal at OPIN Go. Now, coming up right here on Bloomberg Surveillance, what role will finance play in the post-pandemic recovery? We'll speak next with Carmine Di Noia. He's a Consob commissioner about that and much more. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's go straight to one of our interviews of the day. Joining us to talk about the OECD and, of course, the new proposal on corporate governance and much more is Carmine Di Noia. He's commissioner at Consob. Carmine, thank you so much for joining us right here on Bloomberg Surveillance. So there's a new report basically looking at shareholder activism about how governance will change because of the pandemic. What surprised you the most in putting this together with the OECD?
Yeah, I mean, good corporate governance helps to build an environment of trust, transparency, accountability, which is necessary for fostering, long-term investment, financial stability, and business integrity. So supporting stronger growth and more inclusive societies. And well-functioning markets, and that's the work of the OECD, can allocate substantial financial resources for long-term investments. This will make a critical contribution on the road to recovery from the COVID-19 crisis. That's why, actually, I'm deputy chair of the OECD Corporate Governance Committee. That's why we issued these two reports, so the future of corporate governance in capital markets following the crisis, and then the fact book. Why we're doing this? Because we are also trying to adapt the corporate governance and corporate finance framework to, the new situation after COVID, actually readapting our principles. You may know that there is maybe one of the few international world standards is the G20 OECD principles in corporate governance. And that's why also I think you followed also the Venice meeting. The G20 actually underlined and the importance of the revision of the principles. So this is important. Capital markets, and especially in the EU, will be an essential part of the recovery, and corporate governance is an essential instrument to do that.
But how, Mr. Di Noia, how will it change? So do we have the right institutional framework, right, to deal with this and actually go further than what we have right now? Or do we need new rules in the playbook?
We have seen, in the long, I would say the last 20 years, that basically, capital markets, played an essential role for growth, but what is true and is striking is that we had, since 2005, around 30,000 companies which basically delisted, exited from the markets, mergers, acquisition, failure, and so on. And they have not been, this number, completely matched by new listings. So today around we have 40,000 companies there. So institutional framework, I think, and the OECD is underlining that we need, first, an overarching policy objective is to facilitate access to public equity markets for companies and especially for SMEs. So supply and demand. The other side, we need, from the perspective of inclusiveness and financial democracy, we need a well-functioning public equity market, because in this way, ordinary households, they may have the opportunity to directly or indirectly share in the return on capital, and this is very important for the future. And the third thing, which we underline, and this is essential also in all the debate all over the world, the UK, here for the EU, Europe, capital markets, and in the US, we have a large focus by big institutional investors only on large companies. So we need to focus again on what is essential for the growth, which are SMEs, dedicated program, analysis coverage, and so on.
Cabinet, too short a time. We'll get you back on because I also want to talk to you about shareholder activism going forward, especially in Europe, and how the rules change compared to the US. Cabinet Di Noia, Consob Commissioner there. Now, coming up, we'll have plenty more, of course, on the markets, the big data, the inflation data. We'll talk about that. We'll talk about yields. This is Bloomberg.
E3 is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It's a pretty sad testament that we continue to, at a time where we have all-time high stock markets, all-time high real estate prices, that the central banks continue to talk as if the economy is not part of the equation.
The reason why the market's at an all-time high is pretty straightforward. Rates are low and earnings keep coming in strong.
I think great earnings are probably already priced in. If you don't have the incremental fiscal thrust that you're going to get from infrastructure and all the forward-looking earnings guidance, I think that'll probably be deciding the direction of markets from here.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Kaylee Lyons.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, July 13th. Our top stories today: bad news on the bottom line. U.S. banks are poised to report weaker results following that pandemic windfall. We'll hear today from J.P. Morgan and Goldman Sachs. Divided over dividends, the ECB may take steps to ensure banks avoid excessive payouts later this year. In the UK, big banks will be allowed to increase shareholder payouts. And Biden's warning, he'll reportedly tell American companies of the growing risks of operating in Hong Kong. I'm Danny Berger, alongside Francine Lacqua in London and Kaylee Lyons over in New York. Matt Miller off this week. And guys, we finally have something for the markets to sink its teeth into after a quiet start to the week. Francine, we have CPI, we have bank earnings, we have Jay Powell testifying tomorrow. So who wins out? Is it the optimistic equity market, or is it the dour bond market with yields at 1.3%?
Yeah, I'll say. I mean, there's a lot going on. Look, the earnings will basically be the first test of the valuations we got over the last couple of months. And then CPI, I know emerging markets are also looking not only at what happens to the U.S. yield curve, but they're also looking at China, because they were much more hawkish than the rest of emerging markets, and whether that puts extra pressure on them to do something. Kaylee, how's it playing in the markets?
Well, let's pick it up with those Asian markets, Francine, because it was a mostly positive session overnight, with some exceptions, including the Philippines, which actually fell about 1.2% after a ratings downgrade over at Fitch. But you did have Japanese equities, Chinese equities higher, and actually the outperformance came from Hong Kong. The Hang Seng up about 1.6%, shrugging off any concerns about those reports that Biden will issue a warning to companies about operating there. It really was a charge led higher by big tech. That index up nearly 2 full percentage points after Tencent got approval for a merger that eases some concern about the regulatory crackdown from Beijing. As a result, Tencent was higher by about 4%. Of course, the other big news in Asia overnight was the economic data out of China. Export growth accelerating surprisingly 32.2%. The Chinese yuan a bit stronger against the dollar off the back of that, sitting at 647.08. And of course, that is giving some support to commodities. The idea being maybe demand outlook is actually pretty solid, and copper is up a tick today. As for what the picture looks like here in the U.S., is both
Danny and Francine said, we are awaiting those results from the big banks, including JP Morgan and Goldman Sachs, later on this morning. Ahead of that, futures going nowhere, literally unchanged on S&P 500 E-minis. In the bond market, also going nowhere ahead of that CPI data. We're sitting just steady at 1.36% on the 10-year yield. The dollar is just fractionally stronger. And then, of course, I also wanted to point out lumber, Danny. It has now wiped out its entire gain for 2021. At one point, it was trading at $1,733, and yesterday, with a decline of 5.5%, we are back down at under $713, Danny.
Kaylee, I'm going to miss those stories now of people trying to arbitrage the lumber markets, just normal people buying up lumber, hoping that they can make some money off of it. Well, look, you mentioned that you're going nowhere in a U.S. pre-market session, but in Europe, we are going somewhere, albeit opposite direction. That stronger commodity picture you outlined means that UK stocks heading higher by 0.25%, but we're not getting that support elsewhere in Europe, with France down 0.2%, IBEX down 0.7%. We are getting inflation readings in Europe this week as well. So markets definitely waiting on tenterhooks as well to see how that plays out. Now, that means on a headline number, that push and pull between the different sessions means we're just slightly lower today on your Euro Stock 600, down 5 basis points. But the banking picture is fascinating today. We had the ECB, one of the top officials there, saying, look, European banks need to remain cautious when it comes to dividend payouts, and we will have tools to make sure they're not excessive later this year. So that decline in the Euro Stoxx 500 compares to HSBC, of course, one of the big banks here in London and in Hong Kong, up 1.1%, with the BOE opening up the floodgates to dividends, saying you don't need that guardrail anymore. You can give those shareholder payouts. Meanwhile, we're looking at a German 10-year yield that is unchanged at negative 29.5. That's, of course, it's waiting for the CPI like much of the market, Francine. No moves for traders until we figure out what that inflation picture looks like.
Yeah, I have to say, Danny, I'm fascinated by the markets because if you look at the earnings season, it's probably one of the most interesting out there. Just expectations of solid earnings season is definitely filtering through some of the valuations, and it's definitely supporting that stock rally. Now, a look at what else is coming up today. First of all, as Danny and Kaylee were saying, that all-important U.S. inflation data today, June CPI print. Economists on the lookout for where price gains are concentrated and how sticky they look to be. The Fed also holds an event on racism and the economy with a focus on criminal justice. That's at midday Eastern time. We'll focus on a range of regional and Fed governors. And in around 2 hours from now, we'll get the start of U.S. bank earnings. Goldman Sachs up first around 7 a.m. Eastern time, followed by JP Morgan slightly afterwards, and that will give us a good indication again of what they're expecting also with inflation. So let's dive into what to watch out for in those earnings report. Our Sonali Bazak, Bloomberg Wall Street reporter, joins us. Sonali, apart from the beat or missed earnings per share, what are you watching out for these banks?
Right, there are a lot of messy items to look for. Reserve releases being one of them. Hundreds of millions more expected over at JP Morgan. The other thing I'm looking for, Francine, is those trading estimates. I'm really counting pennies here because we're going to want to see the market share gains from JP Morgan and Goldman Sachs in what everybody is calling a moderating market. Traders, even within these banks, are saying that it is going to be one of the most interesting periods we've had in a long time, and that they're worried that investors are overestimating how fast this, or underestimating how fast this normalization is happening. Even now, Wall Street estimates for JP Morgan's trading revenue is well north of what Jamie Dimon had guided for in the quarter. So let's see if they can meet expectations. We won't know the full picture for days, even weeks, as the full estimates, as the full results for all the banks shake out and we see who's gained market share in this kind of environment.
Sonali, across where I am, across the Atlantic, the focus is definitely on dividends today, with the BOE lifting that cap on payouts, but ECB officials saying that they could keep curbs. What is behind that divergence between the two?
The worry about banks lending primarily, giving shareholders returns at the expense of lending more to the economies that still need it. Even here in the U.S., it's still politically charged. Are banks lending enough? Are rates too high? Are interest rates too high for lower income communities, people with perhaps worse credit scores. It's a complicated political calculus. Over at the ECB, even one of the measures they said that could be taken is higher capital requirements, and you know that that scares any banker, Danny. So let's see how hard of a line they end up taking at the end of the day. At the very minimum, if they have that cash to return, investors are going to want to see it. And of course, we know that stock price is highly correlated to a lot of other things, such as talent, such as the ability to grow faster. It's all a very circular issue.
Shonali, thanks so much. Shonali Bazak, our Bloomberg Wall Street reporter. Of course, a reminder, we're expecting JP Morgan around 7 p.m. and then shortly after Goldman Sachs. Now, the Biden administration will reportedly warn American companies this week of the increasing risks of operating in Hong Kong. Now, this is according to the Financial Times. So let's get straight with our chief Asia economics correspondent, Enda Kern. Enda, this feels, I don't know whether it feels significant because it has a huge impact on Hong Kong or because usually when an administration actually issues those warnings, it could escalate very quickly.
Well, there are two angles to it, Francine, according to the FT. On the one hand, the US is concerned about China accessing US companies' data in Hong Kong, and on the other hand, they're worried that China's new security law in Hong Kong will allow them to retaliate against US companies complying with US sanctions against Chinese entities. So it does double down on US tension against Hong Kong. It's another move by the US against China's crackdown on Hong Kong. Last year, they took away Hong Kong's special trading status. They implemented some export controls. So at the very least, while we don't have the details yet other than this FT report, it does speak to the idea that the US is continuing its pressure on China over Hong Kong.
Well, and Enda, we also learned overnight the Biden administration is discussing a proposal for a digital trade agreement with Indo-Pacific economies. What can you tell us about that and the implications for China?
This sounds like a digital rules of the road, essentially, for the new digital economy in this part of the world. On the one hand, it will be mapping out rules over electronics customs and over digital data and the like. That's the kind of economic side of it. But I think the political significance of it is much bigger. Remember, the US pulled out of the TPP during the Trump administration. That was seen as eroding their influence in this part of the world. If they can get back in the game now by pulling together their allies and agreeing on this kind of digital trade deal, that will surely be all about building multilateralism and again showing that the US is back in the game against China. So I'd say it's possibly more significant on the political front than it will be on the economic front.
All right, Bloomberg's Enda Kern, thank you so much. I do want to take a look at some stocks moving in pre-market trading here in the U.S. now, and I'm going to begin with Virgin Galactic because just 24 hours ago, right at this exact moment, I was talking about how it was getting a boost after Richard Branson's successful test flight to space. Then shortly after the open yesterday, the company filed to offer as many as $500 million in shares. As a result, the stock fell 17% on that, and it's lower by another 8% this morning. Another stock falling on a potential stock sale is ChargePoint Holdings, of course, the EV charging company, potentially offering 12 million shares to holders. It's down 5% in early hours as a result. And another stock moving to the downside is AMC, of course, the movie theater chain operator. Maybe you can blame Scarlett Johansson for this because, of course, Disney's Black Widow debuted over the weekend, and Disney said it was almost as popular online as it was in actual theaters. AMC fell 8% on that yesterday. Losses continuing this morning, down 4.5% before the bell, Francine.
Oh my gosh, we need a poll. Who is comfortable to go to the theater? Who's comfortable to go to the cinema? That's our Bloomberg Surveillance Early Edition poll. Now, coming up, Christian Muller-Gleesman, Managing Portfolio Director Strategy, and of course, he's from Goldman Sachs. He's head of asset allocation there, so we'll have plenty more from him. And then a little bit later, Salman Ahmed, he is Fidelity International Global Head of Macro and Strategic Asset Allocation. This is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
This is Bloomberg Surveillance, early edition. I'm Francine Lacqua with Danny Berger in London, Katie Lyons in New York. Matt Miller is off this week. Now onto the markets, and of course the big one to wait out for today is earnings from a lot of the banks, and then of course we have CPI. U.S. futures steady as investors await that U.S. inflation data. Second quarter earnings also will influence some of the world's biggest bank stocks. Well, joining us now is Christian Muller-Gleesman. He's Managing Director of Portfolio Strategy and Asset Allocation at Goldman Sachs. Christian, thank you so much for joining us. When you look at some of the market divergence, I don't know whether we should look at U.S. yields, what we heard from the Fed and inflation, or whether the most interesting part is actually in China, the fact that we had a hawkish stance from China and what that means for the rest of the world.
Yeah, I mean, both are going to be important. I think the market has gone through this amazing, I call it the deflation capitulation. And I think there are multiple drivers here. One of them is the fact that the Fed had this hawkish pivot. It opened itself up now to monetary policy tightening, which depends on the data. So as a result of that, as you said, we have the CPI release today. The market will look very carefully at the components that the Fed cares about, which is not necessarily used cars and restaurants and these type of things, but it is shelter and labor cost inflation. So those areas, if they do show significant upside surprises, it puts pressure on the Fed and possibly the lift of pricing. But I think you're also right. We've certainly in the last few days had a lot of concerns on China growth and policy. I would argue that at the margin, you're seeing a bit of relaxation there after the RRR cut, but I think it's still a key concern.
So, Christian, what does that mean for the commodity complex? Because Danny and I were talking about lumber, how what was a really remarkable rally has turned into a really remarkable cool down, and that's really true for a lot of the commodity complex. Why still be overweight them here?
Yeah, I think you have a quite interesting situation with commodities. I mean, lumber is clearly not the commodity market. It's a very specific situation. Fair. You had the housing boom, and I think maybe a bit of speculation on top. But I think the broader commodity complex is still characterized by excess demand, lack of supply, tactically in particular, but also possibly for the coming cycle. And I think what I like about commodities at this point is that markets are losing confidence in the cycle. Markets are losing confidence in the reflation narrative. Commodities are one of the least forward-looking assets. They're really linked to supply and demand. And guess what? Demand is very strong. We're reopening. We have deficits in pretty much most of the commodity markets. There is, of course, the big one, which is oil. And you had that uncertainty with OPEC. So there's supply uncertainty. But our team thinks that the downside risks from OPEC are still somewhat limited.
So in your latest research, Christian, you also warn about peak growth, peak liquidity coming to the market. How do you want to recalibrate your portfolio in a world where we're at that peak and we're descending now?
Yeah, I mean, like in what I call this reflation moderation phase, you don't need to completely go neutral risk. What we actually find is that if you're peaking in terms of growth, especially at high growth levels, the normalization can still be quite good for risky assets. So equities on average tend to do quite well, at least in the early stages of that growth moderation. But you have to be careful with all these rotations, value versus growth, cyclicals versus defensives. All of these type of rotations within equities get much less consistent, much more bumpy. And generally, like you're going to have more rangy returns. You're not going to have really strong equity returns. And at the margin, that tells you need to focus a bit more on carry. And in equities, for example, going for higher dividend yields has been a strategy which we like, going a bit more for kind of stable growth and defensive growth, which is not completely linked to the cycle.
Christian, so would you say that investors are more focused actually on the worsening virus situation above anything else?
I think it's been a concern, definitely, especially with regards to China, as discussed earlier. It's been a huge contributor probably to that large decline in the data in May and June. And I think at the margin everywhere, you see these pickups in cases, and our clients definitely, a lot of them are self-isolating, telling us stories about their local situations. So it feels like we're definitely going into a bit of a danger zone. Markets have been somewhat on top of that. We've seen some obviously disappointing services data in some areas, but I would argue that the most important thing remains the link between infections and hospitalizations and fatalities. And as of now, what we're seeing is very encouraging, and our economists have been of the view that we're not going to see the same type of template where you get this exponential growth resulting in kind of medical issues, which then lead to lockdowns.
So, Christian, I want to go back to the value growth, value, rotation you were talking about. We are getting results from big banks beginning this morning. JP Morgan and Goldman Sachs are in deck. Do you think this earnings season is going to give fresh impetus to the value trade, or could it give growth another leg up like we've been seeing for the last month or so?
Yeah, it's a really good question. I think at the margin, earnings are always backward looking. So it's tough to get the market excited with a backward looking and kind of positive beat. But I think what's important is that into this earnings season, the sectors that have had the strongest earnings revisions and the big kind of macro tailwinds, like obviously, which are value sectors, banks, commodity sectors, some of the cyclicals, they've actually done really poorly now because of that reflation capitulation. So the hurdle rate with regards to markets being positively surprised by some of those results seems to be much lower compared to the last season, where you remember some of the companies that were beating actually sold off on the day.
Christian, sorry to interrupt you. So, I mean, I'm wondering with these earnings numbers, and quickly here, because we don't have a lot of time, the market consensus has risen 7% for EPS. Is what is being anticipated now for a blockbuster earnings? Does it go far enough? Do you think we could see an upside surprise?
It's going to be tough to have an upside surprise, really, on a headline level. I think the big kind of sectors that at the margin could have an upside surprise, you mentioned it already, banks. I think our analysts don't really think that results will be significantly surprising to the upside. As you already mentioned earlier, the reserve releases could be an upside surprise, but that's not something the market will pay significantly for. It could lead to a bit of a dividend capital return upside surprise, but that's not really a big beat. But what I would say, though, is it might be enough to be in line. Because, as I said, those sectors that have been under pressure, if they're just being in line, could already give the market confidence that these companies are actually fundamentally in a pretty good spot.
Christian, thank you so much for all of your analysis. Christian Müller-Gleisman there of Goldman Sachs. Now, coming up, we'll have plenty more, of course, on the markets. So remember, it's that CPI, all-important data, and we also have American banks reporting coming up later today. White House climate advisor Gina McCarthy will also be speaking on the role of policy at Bloomberg's Sustainable Business Summit. So don't miss that. You can watch it on the terminal live and, of course, on the website as well. This is Bloomberg.
particularly, sort of the technology landscape, gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London and Danny Berger also in London because Matt Miller is off today. Now let's get the first word news. And Prime Minister Boris Johnson's decision to ease coronavirus restrictions in England has led to growing fear and calls for action. Doctors warn that the fresh toll of the pandemic will overburden the National Health Service, and economists expect consumer confidence to fall in the coming weeks because of the perceived threat to public safety. In China, exports unexpectedly rose last month. Growth accelerated to 32% in dollar terms from a year earlier. Imports were also better than expected, rising almost 37%. Still, there are signs that momentum could begin to moderate. And the International Energy Agency warns that oil markets will tighten significantly unless OPEC Plus agrees to increase production. There's deadlock between Saudi Arabia and the UAE. Brent crude is now trading at close to a 2-year high. And we'll have more on commodities, inflation, and, of course, earnings season with Salman Ahmed of Fidelity International. He's coming up next. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lack with Danny Berger in London. Kelly Lyons in New York. Matt Miller is off this week. Now, inflation. Oh no, they're also earning banks. So actually, there's quite a lot, Danny, for markets to get their teeth in. Earnings will give us a good indication where the stocks rally was justified, and then the inflation print will give us a good indication, possibly, to what the Fed can do next.
Exactly. But look, when it comes to equity markets, it's all about the math, Francine. This is what Jim Paulson over at Leffold Group points to, saying that, look, yields at 1.3%, EPS set to be its biggest gain in post-war history. That is a recipe for an equity market that can continue to trot higher. And indeed, we see that. We continue to see equity markets post all-time highs, Francine.
Yeah, we're just also getting a great note from Sebastian Galli of Nordea talking about euro-dollar. Kaylee, what are you seeing in the markets?
Well, as Danny said, we have been climbing higher. We did reach record highs in the U.S. yesterday, but it is worth noting that this morning we're just in a holding pattern, and that's really true on both sides of the Atlantic. Right now, the stock 600 is just fractionally lower, not even 0.1%, and here in the U.S., futures essentially going nowhere. We're down just a point on S&P E-minis, really just waiting for those results from J.P. Morgan and Goldman Sachs coming up in just an hour and a half or 2 hours' time. Also, ahead of that CPI data, we're going nowhere in the bond market. The 10-year Treasury yield steady at 1.36%. A little more movement, though, coming from crude. WTI is up about 0.6%, trading at $74.54 a barrel. As for some stocks moving in pre-market trading, I do want to take a quick check on the latest Reddit trader stock. It is SGO, a Chinese consumer electronics company. Already in just the past 3 days, it has rallied 726%. Yes, you heard that right. And once again, it's up 6% in early hours this morning. Clover Health, of course, another meme stock, is up about 3%. To the downside, though, Virgin Galactic, all of the hype around Richard Branson's spaceflight over the weekend overshadowed by the fact that the company filed for a $500 million share sale, up to it. The stock down 8% this morning after falling 17% yesterday. And finally, I just wanted to check on where JP Morgan is trading ahead of its results. Not going a whole lot anywhere. We're up just about 0.1%, Danny.
Well, Kaylee, I'm looking at a chart that I would like to call, it's a boomer thing. Inflation, it's a boomer thing. Of course, that's not something you, Francine, or I would know about, but this data is from the New York Fed survey of inflation expectations. Also want to welcome our radio listeners as well. And for our listeners, I will describe the chart I have up. So yes, this is inflation expectations, and I have it broken down by age group. So again, for our listeners, the highest inflation expectation comes from the age group of 60 and over. And then from there on out, it descends depending on how old you are in the survey. The lowest inflation expectation comes from those who are 40 and under. So it's fascinating to see. This is a chart brought to my attention by Andreas Steno over at Nordea, and he points out the Fed happens to be run by boomers, Francine.
Yeah, I mean, this is fascinating for me, right, on a number of levels. First of all, I mean, I grew up, looking at 1,000 lira, which made me feel very, very rich in Italy, which it was, I think, less than $1. And then I was speaking to a neighbor here, 85-year-old, who, we're talking about the economy because she loves watching Bloomberg. Thank you so much, Priscilla. And she was saying, she remembered where interest rates here in the UK suddenly went at like 12%, 14%, and higher. This changes your time frame if you've lived through an experience where actually inflation was rampant and, suddenly your mortgage went almost double, if not triple.
Yeah, it totally does. But what happens if, like me, you have the memory of a goldfish and you just remember those lumber prices that were near record highs not that long ago and have fallen? Right. Maybe that's why all the boomers are lower on the survey, Francine.
Yeah, boomers worried about inflation. Joining us now is Salman Ahmed. He is a global head of macro and strategic asset allocation at Fidelity International. Salman, we were talking a little bit about inflation, about how actually inflation perception maybe changes also how cautious people are. Do we still have deflationary worries across the world once we get out of the pandemic, or is it something that actually we shouldn't even talk about?
Hi, Francine. I think there are many factors which are different in the post-pandemic world. And the most important one is, of course, that pandemic was a supply and demand shock, not only a demand shock. So some of these supply side issues, yes, it can potentially get resolved. And we are already seeing some signs of it. Lumber is a good example, which was noted earlier. But when we focus on to some of what is happening in the wage chain, I think there are some signs that these mismatches can continue and then start to feed into inflationary expectations. And our own analysis shows that the way inflation expectations were formed over the last 10, 15 years was very different to what we saw in the 80s and 90s. And that's where the key risk lies. And that's why we need to be very careful about these upside surprises which are passing through the system right now.
Salman, that's on the inflation side. I want to talk about the prospects on the growth side. The Bank of America just releasing their latest fund manager survey. The title is "The Cyclical Boom Has Peaked," because in March, 91% of respondents thought the world economy would improve. This month for July, only 47% of respondents did. What does a world where we've already peaked look like going forward?
On the growth side, I totally agree with you. The narrative seems to be shifting with the peak growth point getting a lot of attention, and the survey numbers you mentioned are probably focused on that. However, one thing I wanted to highlight is that we were never able to sustain the kind of growth we saw after the lockdowns happened and the economy opened up and research. That's a very mechanical way of calculating growth. The critical question is, what level will this growth stabilize at? And we think that is not a recession territory or a very slow below trend growth. It will be solid, for example, around 3% plus when we go beyond this 2021 hump into 2022. So that steady state matters. And I think this kind of narrative that, growth will completely collapse, we think is too premature, because there's still a lot of fiscal stimulus. There's a lot of monetary accommodation still happening.
That's certainly a complicated environment to try to deal in, to try to trade in. I mean, at this point, given the dichotomy between yields and equities, do we have any idea whether we can call bond yields? Can you call which way bonds will move, for example, if we get an upside surprise on CPI data today?
There's no doubt over the last few weeks, some of the moves in the bond markets have been quite perplexing. There's a dilemma, as you rightly pointed out, between equities and bonds. So if bond markets are saying there is a complete collapse of growth or inflation coming through, why isn't the equity market reacting to that? So I think the role of the central bank and the read of the policy or reaction function is important here. And that's where the diversity of opinion has come through. To our minds, I think yields should go up because growth is potentially going to stabilize at a strong level. Inflation surprises are likely to be here for the foreseeable future. And that means that some of this should show up in higher yields. But I totally take your point that this dichotomy is quite severe and has been quite sharp over the last few weeks.
Salman, what exactly is priced in? Is all the good news actually priced in already in stocks? And so are we looking likely for stocks to be disappointed over the summer months?
I've seen on the stock market, as we know, on the index level, things are quite solid. So we have been pro-risk through equities for many, many months now, and we have not been tempering with that view so far. But underneath the index, we know there is a lot of rotation going on. In fact, if you look at the cyclicals versus defensive play and some of the other baskets and themes we monitor, there has been a clear-cut pricing down of growth and inflationary outcomes, which is the reflation trade, which was very active post the vaccine news came through. We think that can come back online as there's more realization and more confirmation that growth is not collapsing and inflation is here to stay. But at the index level, there's a lot of course, support coming through from defensive names, whilst underneath the bonnet, a lot of dislocations have reappeared.
Can we talk about taxes? Salman, you of course have the global tax deal in the works after getting the backing from the G20, and it's not just on the global scale. Here domestically in the U.S., the Biden administration still would like to have higher corporate taxes and higher taxes for higher earners. How are you thinking about the tax equation we're putting together a portfolio right now?
The global tax news on that front was an important one. It's a bold step, and in fact, we're surprised at how quickly the consensus had come through. And in fact, EU, as we know, has also pulled back from the digital levy, which could have jeopardized those developments. So it's a sign that of times to come. In fact, the read from our end on that, how quickly this consensus has come through globally now with G20 and potentially going to OECD, that this is the kind of environment we are likely to be in. However, our thinking is that the first we get the infrastructure bill and the spending stimulus, while 2022 onwards becomes a tax story and it specifically has implication for some specific sectors rather than for the entire economy or broader markets.
Salman, great catching up with you today. Thank you so much, Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Coming up next, Dr. Amish Adalja, Johns Hopkins Center for Health Security Senior Scholar. We'll talk all things COVID and tracking the Delta outbreak. This is Bloomberg.
Estava há um ano sem se apresentar, as escolas estão começando a reabrir, os teatros não vão reabrir tão cedo. Aí a gente teve a ideia, no melhor estilo Minuto Nascimento, vamos levar a música aonde o povo está.
Minha missão hoje é fazer as pessoas sorrirem, cara. Sorrirem, olharem da janela, verem uma coisa inusitada, ficarem felizes, mandarem para os amigos e, enfim, curtirem um momento diferente, mesmo dentro de casa.
Up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix with Danny Berger in London. Kaylee Lyons in New York. Matt Miller is actually off this week. Now let's talk about COVID-19 and new headwinds for the vaccine. J&J, once expected to be the linchpin of the U.S. immunization effort. Now, the fact sheet for Johnson & Johnson's COVID shot was revised to warn of a rare immune system disorder. Well, to talk about all of this, let's get straight to Dr. Amish Adalja. He is at Johns Hopkins Center for Health Security Senior Scholar, and he joins us now from Washington. Dr. Adalja, thank you for joining us. As always, how much of a setback is this for J&J, and how much of a setback is it for emerging markets that were kind of at the front line to receiving the J&J because it's cheaper and it's a one-shot vaccine?
In the United States, the J&J vaccine has sort of lagged because it's been plagued with issues. For example, an 11-day pause after a rare blood clotting disorder was associated with it, a lot of bad headlines about their manufacturing. So it's never been a major component in the U.S., but I do think that this is going to add to vaccine hesitancy in the U.S. with specific to the J&J vaccine. And I think it's unfortunate because when you look at the risk-benefit ratio, this vaccine is still highly favored. And I think it will still be something very important for emerging markets because its advantages, the fact that it's one shot, the fact that it doesn't require extreme cold storage still makes it a very attractive vaccine. And I think what we have to do is really teach people about how to make risk-benefit calculations. And we're talking about 100 cases and over 21 million doses given. This is a very rare type of thing. And I think it's important that people be aware of it. And it's definitely important for clinicians to be on the lookout for this rare side effect when it does occur. But we've seen Guillain-Barré syndrome occur with other vaccines. Guillain-Barré vaccine occurs after, Guillain-Barré syndrome occurs after certain infections. So this is something we anticipated. And it really shows that our safety monitoring systems are picking up these very rare side effects. So people should be reassured. And I think people should still get the Johnson & Johnson vaccine.
Dr. Adalja, speaking of vaccines, I'm wondering if either those who've gotten a Johnson & Johnson or a 2-shot mRNA are going to have to get one, a third or a second relatively soon. We heard Israel yesterday offering a third COVID-19 shot to those with weak immune systems. Are we going to see that in the near future in other countries?
For individuals that are immunosuppressed, I think we're still waiting for some of those studies. We know that they don't react as well to the standard dosing regimen of the vaccines, and there are efforts underway to understand whether a third dose or an additional dose might boost their immunity. But what we want to do is really look at the actual clinical data. Are people who get the normal dosing, are they getting breakthrough infections at a higher rate? And are they getting breakthrough infections that are clinically significant, meaning landing them in the hospital? That, to me, is the threshold for a booster vaccine. And while Israel might be doing something and Pfizer might be saying something, I think we have to continue to look for clinical data to actually support the use of a third dose. And to me, I think in the near term, that's not likely to be the case, especially for the general public. And I think we can argue about immunosuppressed populations, whether or not that third dose is justified. But in general, what we're seeing is these vaccines are very durable, especially when it comes to what matters: serious disease, hospitalization, and death. So to me, I think that booster talk is really premature. It's important to study boosters, to have a pathway for quick approval, but I don't think we're ready to pull the trigger yet.
So, Dr. Adalja, if vaccines are one side of the story, of course, social distancing, behavioral factors are the other side. Here where I am in the UK, you have restrictions starting to ease come the 19th, and at the same time, they're warning of a spike, a potential spike when that happens in COVID cases. In areas like the UK where you have a Delta outbreak, is it too soon to be taking our eye off the ball here in terms of social distancing and other restrictions?
What you have to remember is that the whole reason that COVID-19 became a public health emergency was not because of the cases, but because of its ability to threaten hospitals. In the UK, what we've already seen, even with a lot of Delta variant, is a separation, a decoupling between cases and hospitalizations and deaths. So I think we have to remember that COVID-19 is not going to be something that's eliminated or eradicated. It can't be driven to zero. What we're trying to do is remove its ability to threaten hospitals. So long as your high-risk population, or enough of your high-risk population, is vaccinated, you're going to see cases but not hospitalizations. And I think that's sort of what we're trying to do, is tame this virus, make it more like other respiratory viruses that we deal with year in and year out. And that may be the path that the UK is on, that you'll see cases, but the hospitals will be okay. And I think it's important to increase vaccination rates and to tell people who are unvaccinated that it's important to still be vigilant, wearing a mask in indoor settings, trying to social distance and trying to stay away from crowded congregated places, but most importantly, to get vaccinated. But I think it's going to be a case where many countries will have cases, but they won't have hospitals in crisis once they get enough of their high-risk population vaccinated. And that decoupling, that's what we have to do.
Yeah, in France, not enough people are getting vaccinated. So we actually heard from the president saying he's going to introduce a kind of green passport, or, you know, green thing that basically, not green, but vaccination passport, so that when you go to a restaurant, you have to show that you've been vaccinated. Is that the right thing to do in countries where actually people are afraid of getting vaccinated?
I do think it's very important that people who are fully vaccinated be treated differently, because when you're fully vaccinated, the vaccine treats you different. You're no longer a threat to others, and others are no longer a threat to you. So if private businesses want to use some kind of mechanism to cater to the vaccinated only crowd, I think that's really important. And it also provides an incentive for people to get fully vaccinated, because they can see that this vaccine is something that's of personal value to them. It allows them to reclaim their pre-pandemic life, and it's going to protect them from COVID-19. And for too long, I think we undersold the vaccine and didn't really tell people that this is your ticket to normalcy. And I think that when vaccinated people are able to go back to their normal lives, that's an incentive for unvaccinated people to say that they want that to be their life too.
Well, we know there are certain pockets of the country, at least here in the U.S., where there is still a large number of unvaccinated people. So we will see if that story starts to change. Thank you so much to Dr. Amish Adalja of Johns Hopkins. And of course, we should know the Johns Hopkins Bloomberg School of Public Health is supported by Michael R. Bloomberg, who of course is founder of Bloomberg LP and Bloomberg Philanthropies. And coming up later today, don't miss this, as earnings season gets underway, we will hear from the PepsiCo CFO, Hugh Johnston. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Danny Berger in London, Kayla Lyons in New York, our very own Matt Miller off this week. So the other person in London, or actually New York, who wishes he was in London is Tom Keene, co-anchor of Bloomberg Surveillance. Right. I know, Tom, you're all over. This is like the perfect Keene day. You have earnings, you have bank earnings, and you have an important CPI number.
We got a big CPI number coming up. We'll show that chart in a moment. Dean Kernick will join us, thrilled with that on the market. What's so important here is the VIX has moved to 15.99. We're really getting a bull market tinge here into earnings season. Francine, that's something we'll have to watch today. Gerard Cassidy will stop by on the banks, a legendary analyst at RBC Capital Markets. Let's go to the chart. Inflation, Francine. We showed the EU inflation yesterday. It looks much the same, but this is within economics an iconic chart. There are 5 people at Jackson Hole late August that have this as a tattoo on their left thigh. And the Volcker inflation, down we go. And you could frame the spike up there back to July of 1992. And Francine, I know you know the hit of July 1992, Achy Breaky Heart.
Tom, you're so good. I love it. You should sing to me. I miss actually your singing when we used to do surveillance.
You don't want to hear me sing
the downside,
Achy Breaky Heart.
For I actually, no, I really do. But the downside to some of the emerging market currencies could be what we see with that inflation print. So I know you'll probably also look at the emerging markets, and you have some great guests coming on. Yeah, we do. We got Dean Kernick coming up again, and Gerard Cassidy. And then and don't forget, I'll be doing Balance of Power today for David Weston. Looking forward to the tensions of Washington as well. Yeah, and then in your hours, we also have some of the bank earnings. It kicks off the JP Morgan and then on to Goldman Sachs. Tom Keene, co-anchor of Bloomberg Surveillance, joining us there. Now, this is what else we're watching for the rest of the day. First, I mean, look, we have to start with CPI, and Kaylee, you'll be watching that.
I will. 8:30 a.m. Eastern time. We're looking at a 4 handle on both the core metric and, of course, the headline number. But I also am watching some breaking news, Francine, and that is that Lala Move, which is a delivery company based out of Asia, is said to be moving its billion-dollar IPO from the U.S. to Hong Kong. And of course, this is interesting. It's news we've been following for about a week or so. The crackdown on Chinese companies listing elsewhere in the U.S. and the Chinese government trying to put restrictions around that. Lala Move is said to be concerned that the new China rules could delay its IPO plan, so therefore is looking to move this listing. And Danny, to me, this also ties into banks and the earnings we're about to get, because we know they have been benefiting in a huge way from taking some of these Chinese companies to the public markets here in the U.S. Yes. Those fees, they've really reaped that reward. What happens if that goes away?
You are so right. I was thinking the same exact thing as you said those lines, because look, a lot of these banks, they operate in Hong Kong as well, but the fees that they can get in non-American markets are significantly more thin. So even if they still get that deal activity abroad, it's not going to bring in as much revenue. So sure, that won't impact their earnings this quarter, but we do have JP Morgan at 7 Eastern, Goldman Sachs at 7:30. That very well could be brought up in the analyst questions. Now, beyond that, it's all about loan loss reserves. It's all about, of course, we already knew the dividends coming back. Is loan growth going to be there as well? But also, I want to know about their recruitment efforts. Goldman Sachs quiet on giving bonuses and raising salaries, whereas everyone else has in that recruitment effort, Francine. So, you know, I think banks really globally are going to be interesting today, aren't they?
Yeah, they certainly are. Now, there's the other story with banks. So we are watching, of course, those earnings. They could come. Sometimes JP Morgan surprises and comes out a little bit earlier than expected. But the other story is, of course, what we have with dividends with UK banks and European banks. Now, I've seen a couple of notes, especially from, for example, Fitch, raising the outlook of some of the UK banks after the BOE gave the green light for UK banks to pay back payouts and also dividends. Again, they both, the BOE and the ECB, actually had this ban effectively on dividends to trap capital within the system because they were worried about COVID-19. In a great Bloomberg interview, we heard also from the supervisory board of the ECB that actually payouts for European banks may be delayed. So watch out for dividends. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Seeing consumers go out and spend. They have cash on hand.
There's a liquidity money story here that's being overlooked with this panic about second derivatives.
If the US economy is going to get back to decent shape, you'd have to expect a real yield of zero.
Very strong CPI print that could unnerve the market.
The Fed is incredibly opaque, right? If you give it a lot of goals, it doesn't have many tools to hit all those goals.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The week begins right now from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures unchanged at all-time highs on the S&P, 43.77 on the S&P 500. Tom, what a morning we've got lined up for this audience.
We've got a week begins tone to it, John. I would say really it's the quarter begins, and some would say the rest of the year begins. JP Morgan is what it is. We'll go into some size comparison comparisons here, but these earnings out with JP Morgan in this hour, it's not normal. It's a huge deal.
That should come in about 45 minutes, Tom. About 45 minutes after that, we'll hear from Goldman. Then CPI in America at 8:30 Eastern time. What's your focus this morning?
My focus is on the VIX. It's showing me a bull market. When I walked in, John, I had a print of 15.99. Right now, 15.99. We've seen some real constructive movement in the VIX, and we've got the right guest on volatility coming up.
Dean Kernet just minutes away. Lisa, we've got to talk about that Bank of America Fund Manager Survey too. The cyclical boom has peaked.
And there's a question about the yield curve, people basically decreasing their expectations for a steepening yield curve at a time when we continue to see a flattening there, an expectation for slower growth long term. What does this mean for banks, given the fact that people have rotated into them, then been a bit skeptical of them? How much do the earnings even matter if the yield curve flattens?
Show me some loan growth, Lisa. That's what we want from the guidance, right?
Well, show me loan growth, or at least the potential for it, right? I mean, a lot of people saying perhaps there won't be as much loan growth with all the government support, but give us a sense that people at least are using up their savings and will be prepared to take out loans going forward.
Tuesday morning, good morning. Here's the price action in the equity market. Unchanged on the S&P 500, 43.77. Coming into Tuesday at record highs, all-time highs once again. We are unchanged on your benchmark. Outside of that, into the bond market, yields unchanged too, 136.10 on 10s. Yields going absolutely nowhere, with euro dollar just slightly negative by a little more than 1/10%, Lisa. Euro dollar 118.42.
John, you really nailed it when you talked about the loan growth. That's what a lot of people are going to be most focused on today as we kick off Q2 bank earnings. JP Morgan 7 a.m., Goldman Sachs releasing their report at 7:30 a.m. People are going to be looking at net interest margins. They're going to be looking at trading revenues, which are expected to decline or at least be a little disappointing. However, IPOs and global mergers and acquisitions, a huge boom for these banks. Again, it all lies in consumer loans, credit cards, etc. The idea here is, how much does this tell us about the economy, economic growth going forward, and revenue growth for these big banks? Then at 8:30 a.m., we get U.S. CPI, which is going to be important to see, given the fact that these specific components are going to tell a story about transitory or not. Are we going to see used auto prices continue to climb at the same pace? A lot of that has been driven, frankly, by rental cars, rental car companies that have gone out and been huge bidders at these fleets. Could that subside going forward? And today, Bloomberg Live hosts the Sustainable Business Summit, a really important event hosting the CEOs of BP, AB InBev, as well as Gina McCarthy, the White House climate advisor. And the idea here that I'm looking for is what the response is going to be, especially with some of the strong weather patterns we've seen out of the West, John. I mean, honestly, we haven't talked that much about it, but it has been dramatic, the heat wave that has attacked places that have not seen things like this before. What does this do to crops? What does this do to the rising seas? These are going to be issues they're going to discuss.
Something to put on your radar a little bit later. Straight out the gate this morning with earnings, PepsiCo. So let's get straight to them. TK EPS 172 against an estimate of 153. The comps, this was meant to be the easy quarter, so the analysts were looking for the estimate on organic revenue growth of 7.59%. They beat that and more. It comes in, Tom, at 12.8% in positive territory.
Yeah, and the S&P goes positive green right away. John, this is an incredibly important number, and it is mirroring what we've seen in early, or later quarter announcers of the last 2 weeks. The arrow's in the right direction, organic or internal revenue growth. That's a legitimate statistics for the Frito-Lay company. That's an important number, and it's a really, really constructive number.
The stock is up 1% to 151. They boost their outlook as well.
Forward.
I'll catch up with the CFO, Hugh Johnston, a little bit later
this
morning, Tom. A little bit later in the 9 o'clock hour as we get through the market open. Tom, we've got to talk about costs and cost pressure in the C-suite too, and how this company in particular plans to handle that as the year progresses.
They're going to manage it. They've been through this before. Have they been through a pandemic? No. Have they been through a natural disaster? No. I've sort of played this lightly through the last gloom and doom of the last 90 days. John, these people are experienced at saying, what's the plan to maintain margins? Will they? Gina Martin Adams says, maybe not, but will it be the horror show that people like Lisa talk about? The answer is no.
That's the broader forward look, Lisa, for this market. It comes down to margins.
Yeah, although actually, not to be gloomy, there have been a number of reports showing that companies have done really well at managing margins, which means raising prices, input prices for consumers. You have seen prices go up, or perhaps just the amount of stuff that you end up getting for your money go down. Either way, they're not doing a terrible job so far.
PepsiCo up by 1.67% now in the pre-market. Final word, Tom?
Yeah, potato chips up 7%. Potato chips.
You've been eating.
Up 7%.
You've been eating potato chips.
It's a good
Something you want to share?
No, but potato chips up 7%.
Thanks, Tom.
Pepsi
Dean
House.
Kerner, standing by, Macro Risk Advisors founder and CEO. Dean, good to catch up, sir. Let's just start with this morning. We've got a busy one lined up. What takes your fancy? What are you focused on?
Well, you, I think, started it off just right, which is the market's basically unchanged, and the S&P is at an all-time high. So we've got extremely low volatility. You know, realized volatility is one of the most transparent statistics out there. You can hit it up on your Bloomberg with HVG instantaneously. We look at it all day long, and yet there's actually a lot of information content in it, even as we stare at it all day long. And without realized volatility going up, equity market participants are relatively safe. You just don't see losses in equity markets without the market starting to move considerably more than it is now. You know, there's that old kind of dialogue in markets about the pain trade. Is it rates up, rates down, in FX perhaps with the dollar? But really, there's only one pain trade, and it is in the options market. It's when realized volatility stalls out the way it has. It puts a lot of downward pressure on the folks that are buying options and holding them. And so that's why, as Tom comments, the VIX is now at a 15 handle. So I think that's really something to watch. And the second thing I really say is important is valuation. They say never short a market on valuation. I think that's right. But if you really peel away the onion and you start to look back at the layers within the S&P 500, you'll see just how tech heavy it is. By some measures, it's more tech heavy than it even was at the height of the dot-com bubble, and it's expensive. The ride has been unbelievable if you held on through the lows of March of 2020. And so investors are just finding it very difficult to let that go, even as maybe there are some warning signs around inflation and valuation and concentration at the top of the index. It's so top heavy. It's just very difficult not to be involved in the market.
If it's time, I'm going to rip up the script here, Dean, because this is important for global Wall Street watching before their earnings. Is it so top heavy and so distorted that the mathematics of the four cross moments is no good anymore? That skew doesn't work, kurtosis doesn't work, variance doesn't work. You throw the math out the window because of Amazon, Apple, and the rest.
Yeah, I think that there's something to that. You know, what's interesting, if you, again, go back to the original tech bubble. And I would say, respectfully, there are so many potential signs that we are in an asset price bubble. You see too many things right now. But the original tech bubble, of course, that was a real doozy. And what was very different about then than now is Intel, Microsoft, Cisco, they were highly, highly correlated to each other back then. Right now, when you look at Apple, Amazon, Google, Facebook, the top of the index, Microsoft, you don't actually see the stocks as that correlated. I think that's what limits the risk profile that someone has in being long the NASDAQ or the triple Q. What these stocks actually are correlated to is the directionality of interest rates. And I think that's something we're really supposed to try to understand, is that this, quote, diversifying asset called interest rates, called duration, the TLT, it's really not a diversifier at this point. It's something actually that might amplify the risk in your portfolio, especially as it concerns technology.
Dean,
that correlation, I think, is something we're supposed to watch closely.
This is hugely important, Dean. And just real quick here, are you saying that VIX could be a counterweight, a non-correlated asset to the 60-40 portfolio that's increasingly correlated?
Well, I am saying that VIX and TLT are correlated. And so one of those is not a hedge. If these two things are moving the same way, they're supposed to move in opposite ways. And I think that's where I'm getting uncomfortable. I still think that volatility, Lisa, is really one of the only anti-fragile assets, to quote Nassim Taleb, out there. You know, when things get really bad in markets, there's no doubt that volatility is going to spike. There isn't exactly the same confidence that we can have anymore that interest rates are going to rally as they have, or the bond market's going to rally as it typically is done in risk-on, risk-off fashion. Yep. And what we've seen, and again, it's taken a little bit of a breather as folks have started to buy into the, you know, maybe peak growth or disinflation narrative again, but we've seen the bond market actually be the cause of the risk-off. We saw that taper tantrum type activity start to rear its head a couple of months ago, And boy, at 130 in the 10-year, you just have to wonder what that next 30 to 40 basis point move higher in rates means for the equity market outlook. I'm just not convinced that risk on, risk off, which we've all come to accept, is in play anymore. I think it might actually be the opposite.